Mackenzie in London, and here are your top stories. Hawks ascendant. The ECB follows the Fed with a 50 basis point hike, but over a third of the governing council was said to have pushed for 75. Stocks are lower. The BOE also raises, even as it says inflation may have peaked. Still, Governor Andrew Bailey warns a tight labour market may keep price growth elevated. Plus, the EU backs a 9th package of sanctions against Russia for its invasion of Ukraine. The US hits the nation's richest man with penalties, but spares his company, Norilsk Nickel. Let's take a look at the futures then. What a readjustment for these markets on the back of a trio of 50 basis point hikes from the big major central banks, the Fed, the ECB and the BOE, with the nuances, of course, between all three of those central banks from their heads coming through in terms of the commentary, at least for the Fed and the ECB. You saw a sharp sell-off in government bonds, German bunds, Italian BTPs. That continues this morning. And then, of course, the bloodletting across the equity market stateside and here in Europe. Losses, a biggest drop we've seen in European equity markets yesterday since around May, and then US futures, or at least US markets, closing lower between 2.5% and more than 3% for the Nasdaq. The Spanish IBEX currently down 0.3%, so the losses continue this morning. Have investors handed in the towel now on the back of the hawkish commentary, at least from the ECB and the Fed? The French CAC 40 down by 17 basis points, 17 points, down 0.3%. The FTSE 100 just off by 0.1%, and over in Germany, the DAX is currently range-bound. Let's switch it up then and see how things are playing out, particularly across the currency space, and we will zero in again on sovereign debt. The futures in the US pointing to further losses of 0.2%. Again, the S&P closing lower by around 2.5%, the Nasdaq by more than 3% yesterday. Euro dollar at 106. Just a modest gain, and again the commentary from Madame Lagarde saying that we are not in the same position as the Federal Reserve. We have more work to do, more 50 basis point hikes are coming. How much will that strengthen or underscore the single currency as we look ahead to the weeks and months ahead? The pound at 121, not all the movement for sterling. Again, two members of the MPC actually voting for the Bank of England to hold on its rate hikes. Of course, they didn't get their way, but the divisions were there, a three-way split. The Italian BTPs, you saw a big move higher in yields, 431. You saw a 30 basis point move in the benchmark Italian sovereign yesterday. That continues again. Debt up, yields up, 14 points. The sell-off in bonds continues as markets readjust to these more hawkish central banks. Let's get some more analysis then with Bloomberg's MLive Managing Editor Mark Cudmore. Mark, you are looking at the Euro Stoxx 50 and how all of this plays into investor sentiment around European equities.
Yes, good morning, Tom. You talked about the hawkishness from Christine Lagarde. It was on this slot with you, Tom, 2 days ago. We talked about it was time for the next bear market leg in US stocks. Well, of course, if US stocks are going to start suffering again, you're not going to leave European stocks unscathed. And when they've got a very hawkish central bank to boot, well, it's not going to be a good day. Indeed, Thursday was the worst day for the Euro Stoxx 50 since March this year. And they really kind of tanked lower after a 2-month kind of recovery rally where they've really done well. Now, this yellow dotted line on that chart, that's the average for the price of the past year. I thought it was interesting to note that European stocks are trading above the average of the past year. And I think that without even, being too bearish, you can see they could probably have quite a bit to fall in the next few weeks. However, I am quite bearish, I will say. I want to look at the next chart, because this is just a price chart. The next chart's a longer-term chart. It's a valuation chart going over 15 years. looking at best estimated price-earnings ratio, blended best estimated price-earnings ratio. We're trading about 11.5. The yellow line here is, again, the average. The average is the valuation now, not the price this time, which is about 12.3 over the past 15 years. Now, note, we trade during different kind of periods. We have this COVID period where there was everything was super expensive because so much stimulus was pumped in. That's when the average was pumped up. We also have this period post-GFC where there was a massive discount. There was worried about the European debt crisis, and therefore stocks were very much discounted. That drags the average back down. Perhaps this is the most reflective period, the more normal period in the middle. Or is that normal? That was the easy money period. I think that even though we're below the 15-year average in valuations, I think they can get much cheaper. Remember, unlike this easy money period, we're heading in to an economic zone. The European economy is going into recession, or is in recession possibly already, and yet the central bank is going, we know that, we know growth is poor, and yet we are going to keep on hiking rates. We have a long way to go hike rates. So falling growth, tighter policy, it's not a good mix for stocks. I think they can fall a long way. I think they should start looking very cheap before people get excited, rather than just being a little bit below average.
All right, further to go for these valuations. Bloomberg MLive Managing Editor Mark Cudmore, thank you for that insight. The ECB then, of course, hiking interest rates by a half point as expected, with President Christine Lagarde warning of more such moves ahead to quell the worst inflation in the history of the euro.
We judge that interest rates will still have to rise significantly at a steady pace to reach levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. Our future policy rate decisions will continue to be data-dependent and follow a meeting-by-meeting approach.
Joining us now is Virginie Maisonneuve, Global Equity CIO at Allianz Global Investors. Virginie, as we weigh up the reporting out of Bloomberg that at least 3 members of the committee at the ECB had in fact pushed for 75 basis points, how hawkish do you think this ECB has now become?
Well, I think it is hawkish the same way the Fed is hawkish, in the sense that the market relief rally is going against what central banks are trying to do, which is to tighten financial conditions. So the message had to be in that direction, if you want, in order to avoid more rate increase. So this is the way I look at it, and I think the higher for longer is there until, as we know, labor markets in the US unemployment 4.5% or above %, and in Europe, where we see also an uprooting of some of the potential structural anchoring that we might see.
Yields spiking again, Virginie, on sovereign debt, politically around the periphery. Italian BTPs, 13 basis point move higher. German bunds as well, up 7 basis points on the 10-year. What is the risk of a policy mistake now from these central banks?
There is a risk, of course, and the thing, and this is one of the, in my 2023 outlook, this is one of the risks we have to flag. The tightening we've had is one of the fastest and also one of the largest in the last 40 years. And as we know, it takes about 12 to 18 months for tightening conditions to have an impact on the economy. And so if you look at some of the measures that I look at, like the San Francisco Fed proxy Fed fund rates that adjust for QT, we're already at 6.5% versus bond yield, 3.5 or so. If you look at M2, the change of monetary supply growth year on year, M2 in the US -7%. So we are seeing now the impact, but we have to remember we started tightening not even a year ago. So that is going to hit in the first quarter. And the evidence of that is the disinflation trends that we see coming in the pipeline.
Well, let's unpack that a little bit, because the question has to be then, and tying to my previous one about a policy mistake, is that just as the central banks misjudge the nature of inflation and how transient or not it would be, there's an argument that they're going to misjudge this recession. 0.5% is the growth forecast for the ECB for next year. They don't see it getting back in terms of inflation to 2% until 2025. What is your view on how this recession unfolds in the ECB in the Eurozone, if indeed that is what we're looking at?
Well, I think so. The first part of your question is there an advertising game here that central banks or, the messaging, as we know, there's always a messaging and the action, right? And the messaging is supposed to help perhaps with action being less intense, if you want. In terms of recessions, we know recession in Europe will be more intense than in the US, most likely. But the key thing is also to think about what's happening in the energy market, because as we know for Europe, given the level of support that we have in terms of all the measures, some people estimated at 600 billion, right, in terms of supporting from a fiscal standpoint, going through that energy transition, that is a very important factor. And there you have to look at China.
Yeah, and we want to get your views on China in the next few minutes. But in terms of a potential earnings recession then, just to get your views on these equity markets, Virginie, how much and to what extent has the slowdown in growth in combination with these higher rates and that energy shock been priced into EPS expectations as we look through to 2023?
Not yet, not yet. So, again, I look at lead indicators like the CEO surveys in the US. And if you put that with a lag of 12 months for EPS growth, you have much more to fall on that. We've started to adjust, and actually quite rapidly versus, 2 or 3 months ago, and we know that was coming. The problem for companies is that the visibility, given the speed of the tightening, was very difficult for them to assess. But it is coming. Personally, I believe that once this is in the price, once we have those downgrades, this is the last wave, if you want, and this is where you have to buy, as opposed to prior, those relief rallies that came at every junction of shift in sentiment that we could see. But yes, earnings per share need to fall quite substantially.
Okay, so that's potentially the trigger then to re-enter in terms of these equity markets, is looking for those downgrades into 2022-2023. Virginie Maisonneuve, always fantastic, going to stay with us, Global Equity CIO at Allianz Global Investors. Get more of her calls just in the next few minutes and the assessment as to the impact of a reopened China for next year as well. Coming up, Bloomberg understands, talking of China, that the border between Hong Kong and mainland China is set to fully reopen for the first time in 3 years. Huge news for the economy of Hong Kong. That's as COVID restrictions ease, of course, across the mainland. We'll get more details in the next few minutes. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betrayed you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the Open. We are 13 minutes into the European trading day. Happy Friday. The stocks across the European benchmark currently down 0.2%, but really the action is in the bond market and continues to be, given the yield spikes that we saw yesterday on Bunds, BTPs, and that continues today. German Bunds currently the benchmark's 215. That's a move higher in terms of yields by basis points, 7 basis points. Italian BTPs, that's an 11 basis point move higher at 428. Let's get back to what's happening across China then and the importance of the spread of COVID for that economy. Beijing's rapidly spreading COVID outbreak has turned the Chinese capital of 22 million people into a virtual ghost town. That's as stores close and restaurants empty. It does underscore the cost of President Xi Jinping's sudden pivot away from COVID zero. Joining me now is Bloomberg's Alan Wan, who's been on the ground in Shanghai and across China monitoring this for us. What is the mood then in Beijing, Alan? And are things getting better or worse when it comes to how this city grapples with COVID?
Well, first of all, it's my buddy in Beijing called it a ghost town just because he's seeing more people out and about now than before the reopening. I mean, the mood has calmed a bit since we saw some stock images last week of long lines at hospitals, shortages of medicine in the pharmacies, and even garbage piling up. I think the reason why things have calmed down is because there are more fever clinics being opened up. There are government pronouncements saying there's going to be a fourth COVID vaccination, a second booster for old people. And I think that a lot of folks are starting to pay heed to authorities when they say that if you have mild symptoms, stay home. That said, though, you know, we haven't seen a lot of many deaths so far, right? Any reported deaths, but that's always a concern. Just because what did we see earlier this year in Hong Kong, when they reopened, a lot of old people who were unvaccinated died, right? So that's always going to be a concern.
Yeah, absolutely. A deep concern about the death rate, the potential death rate over in China. Alan, before we get to the next question around the growth prospects for China, I'm just going to bring some breaking news for our viewers. The redhead crossing the terminal now on France and December manufacturing PMI. Purchasing Manufacturers Index, of course, Managers Index coming in at 48.9, so actually better than the forecast of 48, still within contractionary environment, of course. 50, anything below 50 is contraction, but it is significantly better than the forecast, 48.9. Just checking the euro on the back of this, not all the moves. Euro currently up about 0.1%. Services, December services PMI falling to 48.1, so that is a bit of a bruising in terms of the services data out of France. So there's divergence between manufacturing, which is a beat, versus the services number, which is coming in weaker than the forecasts at 48.1 versus forecasts of 49. Both data points in contractionary territory. Alan, when it comes to the growth prospects of China, downgrades in terms of forecasts, at least readjustments of forecasts by UBS and others as they weigh up the spread of COVID and what it means for that economy.
You know something, I'm surprised analysts aren't getting whiplash from all the changes they've had to make since the start of the month. Just like you said, UBS and ANC are both revising down their forecast for this year and revising them up for next year just because of the spread of the virus. I believe UBS is cutting their forecast for this year to 2.7% and raising it for next year to 4.9%. But to be honest with you, this is not a hard call, right? Based on all the high frequency data we've been seeing over the past week. Several measures of economic activity, traffic congestion, travel between cities, consumer confidence, they're all down this week. And it looks like, these things aren't going to pick up anytime soon.
Okay, Bloomberg's Alan Wan on the ground for us in Shanghai on the latest when it comes to the spread of COVID and the implications then looking forward for that growth picture for China. Let's bring back Virginie Maisonneuve, Global Equity CIO at Allianz Global Investors. And Virginie, you say in your note to us that there is a risk of underestimating the role of China next year. Explain.
Yes, so I think as China has shifted its policy towards COVID, or what they call time paying, laying flat, to let it happen, basically, probably with the understanding that the current variant is not as deadly as the previous ones, and that, as they said in a lot of the messaging to the country, they've learned a lot, et cetera, et cetera. So as this happens, you go from a lockdown position to a reopening position, but of course, the number of people who will get COVID, I think, we've all gotten it, means that the economy won't go back to normal in a straight line. But what that means is China coming back to a more normalized, although slowly, level of demand will have an impact on the energy market at the time where the rest of the world is weakening. And that's really, really important, because a lot of the support for the rally in Europe, for example, recently was based on lower energy prices. So I think that's one thing. The second thing is the reopening trade will happen. In terms of services, it would benefit mostly inland China, domestic China. So services, travel, inbound travel, et cetera, et cetera. And I think people are still very cautious about exposure to China. And I believe on a long-term basis, any weakness is an opportunity to add.
Okay, weakness is an opportunity to add. Do you get direct exposure then, Virginie? Do you buy a trip.com? Do you buy some of the hotels, some of the travel companies? Or do you want to be buying European equities, European companies that have exposure and sell into that market?
So, I can't give specific stock tips, but I think you want to have a diversified approach, and definitely some of the A shares are very interesting. I like to think of it as themes in terms of, innovation, in terms of areas of the market where you find quality, resilience, and good valuation. But all this fits into a bigger picture of diversification overall for 2023, given the volatility that we're going to face on a global basis.
Virginie, before we let you go, we're seeing a pronounced sell-off both in bonds and equities once again today. And again, European equities, for the context, dropping to the lowest level since May yesterday. And that sell-off continues today. Virginie, where do you hide out as you await for those opportunities and that transition into 2023?
Well, I think, again, you have to think of structure of your portfolio. You need to build a diversification on a quantamental or low vol strategy just to make sure you anchor the portfolio. Then on top of that, you need to have quality and resilience, both in terms of value, quality value with income, quality growth, and then on the top of the pyramid, if I can call it this way, some very high conviction thematic bets around smart energy, food security, climate, cyber, security, etc. And I think as the market continues to adjust, you adjust the levels of the three buckets, if you want, within equities.
Okay, an opportunity around high conviction thematics as we weigh up these recession risks and, of course, a higher rates environment. Virginie Maisonneuve, always fantastic. Happy Friday. Thank you for coming on. Have a great weekend. Global Equity CIO at Allianz Global Investors. Coming up, EU member states are said to back a ninth package of sanctions on Russia, this time targeting drone imports and banks. That story and the details next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Daybreak.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open. 23 minutes into the European trading day. Losses across the European benchmark of 0.5%, and the futures also heading lower quite sharply stateside after losses of between 2.5% and 3.3%. The S&P E-minis down 0.6%. Nasdaq futures after a bruising yesterday down 0.7%. Let's get your first word news now. And about 200 Chinese companies no longer face an immediate threat of being booted off American stock exchanges. The U.S. Public Company Accounting Oversight Board says its inspectors have been able to sufficiently review audit documents from firms listed in the US. The announcement came after recent inspections by the board in Hong Kong, which was a major breakthrough in the long-running dispute. Slovakia's government has been toppled after its ruling coalition lost a motion of no confidence yesterday, initiated by the Freedom and Solidarity Party, who withdrew from government in September. The vote deepens the political chaos, where months of infighting has hampered legislation and makes a snap election more likely in a country with pro-Russian opposition leaders. Pubs and restaurants in London that survived COVID are now facing another threat: persistent train strikes. Restaurant seatings on the first day of rail strikes this week collapsed to levels not seen since Omicron, when face masks were compulsory on public transport and the government was telling people to work from home. Earlier this week, office occupancy in the capital fell to around 20%, compared to more than 50% at times before the strikes. And the Philippine Central Bank has raised its benchmark interest rate to a 14-year high, joining others around the world attempting to crack down on inflation. In an exclusive interview with Bloomberg TV, Governor Felipe Medalla told us that more tightening is yet to come.
Our own forecast is that inflation will be back to 2 to 4% by the third or fourth quarter of next year. So in other words, what we have to do is do more to make sure that that happens.
That is your Bloomberg First Word News. Let's check in on some of the individual stocks on the move, some idiosyncratic stories to bring to your attention. Infineon, this of course is the German semiconductor maker, and they have announced that Herbert Diess, formerly of course of Volkswagen, formerly the CEO there, is now becoming the chairman of Infineon. You can see the company down, the stock down just 0.6%, but an important change at the top there. Subsea, this is an oil services company signing a couple of contracts with Norway, or at least Aker BP, to work offshore, currently up 0.6%. And Games Workshop, look at that, rounding up 14% almost in terms of the game there, signing a deal with Amazon to produce films. Good news for you gaming geeks out there. A big jump for Games Workshop. Across your broader markets, losses still across the European space of 0.5%, and the futures are looking ugly stateside. Plenty more, though, on Tesla and Elon Musk coming up. Stay with us. This is Bloomberg.
been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Hawks ascendant. The ECB follows the Fed with a 50 basis point hike, but over a third of the Governing Council was said to have pushed for 75. Stocks are lower. The BOE also raises, even as it says inflation may have peaked. Still, Governor Andrew Bailey warns a tight labour market may keep price growth elevated. Plus, the EU backs a 9th package of sanctions against Russia for its invasion of Ukraine. The US, meanwhile, hitting the nation's richest man with penalties, but spares his company, Norilsk Nickel. A redhead crossing a terminal right now. Germany, December manufacturing PMI coming in above the forecasts, 47.4. The forecast was for 46.3, so it's a beat for manufacturing PMI out of Germany for the month of December, still in contractionary territory. Services PMI also a beat, and a significant one, 49 versus the forecasts of 46.3. So a pretty solid beat in terms of the services PMI for the month of December out of Germany. But again, still within that contractionary territory. Not a lot of movement when it comes to euro dollar, currently at 1.06. And we had some divergence when it came to the French PMI data out 15 minutes ago, with manufacturing coming in above expectations, but services slightly softer. But it is a beat on both counts for German manufacturing and services PMI. So that is a check on the latest health, of course, of this Eurozone economy, at least the largest economy within the Eurozone, at a time, of course, when the ECB is forecasting just 0.5% growth in 2023. Let's check in on these markets then. We've had a little look at euro dollar, but the sell-off in equities continues, down 0.6% across the benchmark. Don't forget, you saw the biggest drop since May across European equities yesterday on the back of the hawkish commentary from Madame Lagarde, saying there are more 50 basis point hikes in the pipeline. The fight against inflation continues, and of course Bloomberg's reporting that at least 3 members of the Governing Council were pushing for 75 basis points. They went for 50, they got it up to 2%. Markets expecting the top rate from the ECB to hit at least 3% next year. The DAX currently down 0.4%, a drop of 53 points, below 14,000 now for the DAX, and the FTSE 100 below 7,400, currently at 7,391. That is a drop of 0.5%. Andrew Bailey and co signalling that inflation may have peaked in the UK, but raising rates by 50 basis points, a 3-way split in terms of how they made that decision. Let's quickly look at the sectors then, and in terms of the selling pressure that we're seeing, most pronounced in telecoms, but also real estate. Just 2 sectors in the green. Autos up 0.3%, and banks up 0.1%. Really, the action is in the bond markets, though. That is the most excitement in terms of the action today, particularly in BTPs. And you're looking, 340 is a level that may be viewed by some within these markets when it comes to the Italian 2-year. It's currently at 314. That's a move higher by 10 basis points after a 30 basis point move on the 10-year yesterday, higher in yields. German bunds also continuing to sell off. And that takes us nicely into what's happening on the ground in Brussels, but this time around the geopolitics. European leaders meeting in Brussels are said to have agreed to a new package of sanctions on Russia. They also urged European energy ministers to complete a deal on a price cap on natural gas as soon as Monday. For more, let's go to our correspondent Maria Tadeo, who is in Brussels for us. Maria, what was agreed last night? How consequential was it?
Yes, Tom, and first of all, excuse my voice. I, too, have the cold from hell. But if you look at what happened last night, and this was the last meeting of European leaders of the year, a lot on the agenda and a lot agreed. Now, sanctions, as you mentioned, on Russia, approved. They look at a number of banks, they look at a number of individuals, but in particular, drone technology. They want to drain Russia's ability to grain or to hit Ukraine with drones by putting in place export bans on technology that can help those drones being made and facilitated to Russia. Then secondly, as you mentioned, there was yesterday, not on paper, but this is crucial, a political message sent by European leaders to get this energy deal done on Monday. The mood, I'm told by sources in the room yesterday, was let's just get it done. Let's get it done before the winter. Let's get it done before the end of the year. The pressure is now on energy ministers on Monday when they meet here in Brussels.
So there's the momentum. Is it realistic that they'll get across the line within that time frame, Maria?
Look, there is the momentum. Is it realistic? If you had asked me that question 2 days ago, I would have said no. But yesterday, my reading from the meeting that was going on, the information that we have, the reporting that we've done is that there was, again, a lot of political weight thrown into this. The overall majority of leaders agreed we have to get something done on Monday, especially after that whipsaw from the European Central Bank. You cannot leave and wrap the year without a deal on energy too. Now the tension, and this is what remains unresolved though, is the price range for the cap. We hear it has gone down to 270. Remember, that was the original proposal from the Commission, to now about 160 to 200 euros. That is what's at play. That has not been decided yet, but that is the range that they now target.
Okay, so it's around the details of the range that they're targeting. But as you say, they made significant progress when it comes to this 9th set of sanctions. So will they be able to carry that momentum over into Monday? Maria today, of course, will be monitoring that forwards. Always excellent. Thank you, Maria. Worth noting as well, and this is another story that's been unfolding in the last week or so, the European Parliament has voted to stop legislative work related to Qatar and called for barring the country's representatives from the legislature. It comes after the Gulf state was allegedly tied to a corruption scandal where police seized more than €1.5 million in cash. The Parliament is reeling after Vice President Eva Kaili and former member Pier Anthony Panzeri were arrested on money laundering and corruption charges. Now, let's switch focus to what is happening in the world of Elon Musk. Twitter suspending accounts of upstart rival service Mastodon and, importantly, several prominent journalists covering its billionaire owner, Elon Musk. Musk accused those reporters of endangering his family by revealing personal location information. Joining me now is Quick Takes tech lead Alex Webb. Alex, Elon Musk saying that the suspensions have been put in place for doxing. First of all, remind us what doxing is. And what is the justification? Is it justified, essentially?
Well, so doxing essentially if you reveal someone's personal details, including their location, their name, their phone number. There is an account on Twitter called, I think, Elon Jet, or there was an account on Twitter called Elon Jet, which used a bot to scrape publicly available information about the location of Elon's private jet. And there seems to have been some sort of threat maybe on his life or on his family. We don't know if it's associated with the location of his debt. This appears to be a reaction to that. What does it say about his running of the company? Well, look, This is a private company. He can do whatever he wants. You know, there's all this talk about free speech. He's called himself a free speech absolutist. Ultimately, free speech pertains to the government. The government's ability and willingness to prevent you from expressing your opinion. Private companies can do really whatever they want, even if you were to disagree with this thing. The thing is that he said that these journalists linked to that account, to the Elon Jet account.
Yeah, I mean, it's pretty fascinating. I mean, as you say, free speech, even for Elon Musk, clearly has its limits. But we're not just talking, we're talking about established journalists, Wall Street Journal, CNN, the New York Times. What does it say about his leadership style, and what has the reaction been to this?
I mean, clearly there's a lot of, it's run according to his whims, right? You know, this is a quick reactive response to something. It doesn't seem to have been well enunciated. Here are the exact reasons I'm doing it. This is a change in policy. He appears to have reacted, you know, with a certain amount of, I don't know, perhaps anger to the seemingly threats on his family. It is his company. He can do what he wants, for better or for worse. And if that leads to detrimental results for the company, that's ultimately his prerogative.
Yeah, you can absolutely understand his concerns around security, but then the question is, to what extent is he broadening this out to journalists legitimately doing their job on reporting, even if it is critical on him and his companies? Talking of which, he's obviously sold a pretty significant chunk of shares, once again, around $3.5 billion in Tesla, to help, arguably, his financial situation, which is pretty challenging around Twitter. What has the market reaction been to that?
Well, Tesla shares have lost a huge amount of value. They've dipped below 500 billion for the first time in several years. He has at this stage sold, according to Bloomberg estimates, in the order of $40 billion worth of stock. And almost at every time he does so, he says, I'm done. This is the last time I'm doing it. Then, of course, it happens again. He has huge capital requirements at Twitter, not least the debt obligations, which have now been, you know, reported widely, by us at least, that he owes Twitter owes $1.2 billion a year to service the debt that was, you know, raised in order to acquire the company. That, you know, forgets the money it costs to actually run Twitter as well. We've seen a mass exodus of advertisers from the platform because they're concerned about brand safety there. There's a fantastic story from our colleagues in this week's edition of Business Week where they put us in the room with some conversations that Elon has had with advertisers, where he is sort of live tweeting conversations. That is not the sort of thing that builds brand trust if you're a brand looking to go on the platform.
Ooh, wow, that sounds like a story worth checking out. I haven't seen that one yet. Fascinating. And the amount of that he sold, $3.5 billion, aligning then pretty neatly with the $3 billion or so in terms of the higher yielding debt he's taken on, I think about 11%. Alex, always fantastic. The update, of course, on Elon Musk. We'll be getting you back, I'm sure, on a daily basis as this continues to unfold. Of course, Alex Webb from Bloomberg Quick Take and our tech lead. Coming up, we're going to be speaking to Indonesia's coordinating minister for Investment and Maritime Affairs. A really important conversation, particularly as we look ahead to the prospects around the commodity complex in 2023 within this recessionary environment. Stay with us for that conversation. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
the secret success of any company is to grow. And I think that we, WPP, and our industry more broadly, can be really at the heart of a client's growth. You know, how do they succeed with consumers? How do they reach them in new areas? How do they innovate? How do they create new brands?
Welcome back to the Open. We are 43 minutes into the European trading day. Now, Goldman Sachs says commodities will again be the best performing asset class next year. The bank's global head of commodities research, Jeff Curry, told us that smart investors should expect over 40% returns. Well, at this point, as we discuss commodities, let's bring in someone who is central to global commodities, Indonesia's coordinating minister for investment and maritime affairs, Luhut Binsar Panjaitan. Indonesia's of course, one of the world's major suppliers of commodities, from coal to nickel to copper and gas. Minister, thank you very much for coming into the studio. As we assess then the demand for commodities into 2023, does that bullish forecast from Goldman Sachs align with what you're seeing on the ground in that important nation of Indonesia when it comes to the supply of commodities in a recessionary environment that appears to be shaping up for next year?
Yes, I think the commodity price is very beautiful for Indonesia, but not only the commodity price. Used to be, we rely on the commodity price only, but today, since 7 years ago, we have a downstream industry in Indonesia, like nickel ore, and then we set up the, the ecosystem of the lithium battery, and also we produce the electric vehicle. This part, I think, very, very important to understand. So Indonesia rely on the commodity price, but also with the downstream industry, also efficiency, and also what we call it the village funds. So this is, I think, the pillar of our economy today. So efficiency in Indonesia with digitalization, I think, moving very well today. So I'm proud to say that G20, I think, last month also we proved it, that Indonesia delivers something which is, I think, contribute to the world.
Yeah, the importance of that focus on downstream, so adding value to the commodities that you are enriched with in Indonesia, of course, a central focus for you and your president. But in terms of that recession impact, are you concerned that that shift, that demand for commodities and the downstream, that value add, is going to be impacted by a recessionary environment next year?
Well, yes, but as long as we manage our economy, prudently, and we look at also our experience the last 3-4 years, we are pretty confident our economy next year is going to be okay. Although we have to watch this carefully. I mean, time to time, because the movement very, very fast. And we learn also from the G20 meeting last time. Learn from the member of G20, and we have a forum over there. I think business forum, THK forum. And global blended finance also, we learn how do we can fit into this, our economic growth in Indonesia. So we are pretty confident.
Okay, you set yourselves a target of an investment target of attracting $76 billion this year. Are you on track to hit that target? Where are you in meeting that $76 billion target?
I'm proud to inform you, pipeline already at $31 billion just for the downstream industry. So right now, ongoing discussion finalized with CATL, with LG, the lithium battery production. We have, I think this one, $6 billion investment. And beside that, we have also $132 billion one spot, integrated industry in North Kalimantan. This is also energy by the hydropower like 11 gigawatt. So we are pretty confident on that. I don't see much issue, but we have to be prudent also to watch this carefully, because dynamic of economy globally is very, very...
So to be clear, you think you hit that $76 billion target for this year?
I don't see that any big problem in that.
And do you think you meet the even more ambitious target for next year, given the global downturn?
Yes.
You think you can? What do you need to do to ensure you meet that?
Well, you see, now the confidence if you look at our inflation now, inflation are around 5%. If you look at our economy, the last quarter grew 5.7%. So what else? This, I think, the indicator of our economy, and also our current account used to be deficit. Today, current account, if you look at number now, it's like 2.3 or something, you know. So all the economic indicators showing that Indonesia is on the right track, you know. So we are very proud of that. So because we have so many mineral in Indonesia, we have nickel ore, we have a bauxite, we have tin, we have what else? You name it. Yeah. So now we have we build the ecosystem of this. So we are not rely on the commodity price. Of course, we enjoy it very much with the palm oil price and also with the coal price. Although, well, this one going to be, down maybe for the next 10 years.
One of the big news items that came out of the G20, of course, hosted in Bali by you and the Indonesian government, was this announcement around $20 billion from the US and Japan to support the transition to renewables within Indonesia. Can you tell us how much of that is going to be made up of grants and how much will be made up of debt?
Well, I don't know yet the proportion of this, but we had a very good meeting yesterday with G-Fund here in the Stanchart office, and some 7 bankers, big bankers on this. And we set up task force, joint task force with the Indonesian government and G-Fund. So hopefully by next week, next week, they're going to visit Indonesia to see the task force, and hopefully by January we can announce maybe the pilot project like 500 megawatt of diesel that we can replace by solar panel.
And can you commit to no new coal power stations next year?
Sorry?
Can you commit to building no new coal power stations next year?
Well, in Java Island, yes. But outside of Java, because you have to understand, Indonesia is not continent country, you know. Yeah, each island has their own agenda. Yeah. But don't forget also, our contribution to the carbon emission is still 2.3 million ton per capita. Yeah, okay. But the baseline of this is 4.5 ton per capita, while the other developed country, they already contribute like 14.7 ton per capita. So we are still far behind. So we have to be fair also.
Okay. And in terms of the value add, I know you've been having, at least you've been looking to have conversations with Tesla in terms of not just building the batteries within Indonesia, but building the cars. Have you had any progress? Has Elon Musk given you any sign that he's going to be keen to do that, manufacturing Teslas in
Well, we had NDA with Tesla, but I think something going on right now. I cannot disclose here, but hopefully we'll see something happen by January or maybe latest February.
And you've also discussed, or at least your government's discussed, a potential tax on nickel, which is essential to those batteries. Do you know when that's going to be kicking in and at what level?
Well, we study now carefully about this because we are the largest nickel producers globally. We like to see also the sustainability. We're not going to impose immediately tariff or tax something like this. We have to study this carefully. The government of Indonesia always looking to the, equality, to win-win. We don't want to impose something while this can hurt the investor. No, at all. And then we have to be competitive also to the countries surrounding Indonesia.
Okay, Minister, we really appreciate your time. Thank you for coming.
Thank you so much.
The studio, of course. That is Luhut Binsar Panjaitan, Indonesia's coordinating minister for investment and maritime affairs, a retired 4-star Army general, formerly commander of the Special Forces of Indonesia as well. Thank you. We appreciate your time as you look to that investment in that economy. Coming up, we're just 2 days away from the World Cup, of course, and the final, and the excitement among fans and Manas Crani is reaching fever pitch. We are live in Qatar. That is next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
We are just 2 days away, of course, from the World Cup final in Qatar, where Argentina and France will face off for football's ultimate prize. Our colleague and Bloomberg's ultimate prize, Manus Cranney, is at the Lusail Stadium in Qatar, where the final would take place on Sunday. Manus, will this World Cup be considered a success?
If they keep buying the merch, yeah, it will. In terms of viewership, it's blinding. In terms of spend, phenomenal. 80, 90% ahead of where we were on the spend for the 2018 World Cup. This is a $300 billion long-term trade.
Wow.
The Qataris lumped in, looked large, and traded it. 45 billion bucks, in part, went on that stadium. We're at the Lusail City, which is part of the legacy, part of the phenomena. 8 stadia. Did they rebrand themselves? Did they catch the zeitgeist of the World Cup? Has the world looked at Qatar through a different prism? Depends who you talk to, Tom. If you talk about LGBT rights, no, it's been pretty awful. If you talk about workers' rights, no, it's been pretty awful. But through a prism which you very rarely see at home in London, or indeed in the United States of America, there's a galvanizing of the GCC. MBS came here, sat with the Al Thanis, the ruling family of Qatar, building the momentum for another Middle Eastern country to host the World Cup, maybe, but they may well suffer the same issues. But spend, spend, spend. They'll get a boost on GDP, 10%. Population up by nearly 30% in the run-up to this. Will they stay? Will they go? That is the great debate, the scale of the exodus and the legacy of the stadiums. Tom.
Manus, fantastic. Mbappe or Messi? Manus, very quickly.
Oh, Messi for the 5 goals that he scored. What more damage can he do on Sunday night in that stadium against the French? Tom, it's a big one. Let's give it another go.
Okay, for me it's Allez les Bleus. Manus, thank you. We'll be back with Manus on Monday. Fantastic. Thank you, Manus. Across your European markets, you're seeing losses now of 0.9%. Futures in the US pointing down by more than 1%. Surveillance, early edition, is up next. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, standing in for Francine. Here's what's coming up on today's program. Hawks ascendant. The ECB follows the Fed with a 50 basis point hike, but over a third of the Governing Council were said to have pushed for 75. Stocks keep moving lower. The EU backs a ninth package of sanctions against Russia for its invasion of Ukraine. The U.S. hits the nation's richest man with penalties, but spares his company, Norilsk Nickel. Plus, PMI surprise. Business activity in France contracted at a faster rate, while the downturn in Germany shows signs of easing as inflation cools. Well, that was the numbers for Germany and France. Euro area data coming in. December services PMI at 49.1. That is a solid beat on the services front. It was expected to come in at 48.5. For manufacturing, that is also a beat, but not as strong, coming in at 47.8. The forecast had been for 47.1. Let's see if that's having any impact on this bond market, because we started the morning with weakening across European sovereigns, and that is continuing. Your German 10-year yields, that is higher by 9 basis points. BTPs higher by 16 basis points. Yesterday, these moves were massive off the back of a very hawkish Christine Lagarde. Germany saw its biggest move since 2008. Italian bonds, their biggest move since March 2020. So that continues, with ECB Governing Council member Mueller saying that they need to hike more than the market currently expects. The market needs to readjust. That is certainly what we're seeing today. Of course, always concerning when Italian yields blow out more than the rest of Europe. Is the TPI protection going to have to come in soon, with the ECB starting their QT? Meanwhile, the bad news continues. European stocks, those are down 0.9%. Yesterday was the 5th worst day of this year for European stocks off the back of that ECB meeting. But will this finally mean that a euro can resurge? We are looking at a stronger euro versus the dollar at 106. So here's the overall European map. It's really hard to find any countries that are spared from the ugliness of today's trading session. The DAX, that's down about 0.7. CAC 40 down 0.9. UK FTSE 100, that's doing a little bit better. That's down just about 0.5%. But it is some ugly trading as we head into the end of the year. The Santa Claus rally not yet appearing for Europe. So let's really dig into that story, because the ECB hiked interest rates by 0.5 point, with President Christine Lagarde warning that there were more moves ahead just like that to quell the worst inflation in the history of the euro.
We judge that interest rates will still have to rise significantly at a steady pace to reach levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. Our future policy rate decisions will continue to be data-dependent and follow a meeting-by-meeting approach.
Joining us now is Andrew Pease, Russell Investment Global Head of Investment Strategy, and Bloomberg's Joe Easton. Thank you both so much for joining this morning. Joe, I want to start with you just to kind of set the scene of the ugliness for risk markets yesterday. I said the stat before, European stocks, one of their worst days so far this year, and it seems that the ugliness is continuing.
Yes, as you mentioned, I think it was the worst day since May yesterday, and then down again today. So clearly, Lagarde comments were the main driver, being more, hawkish than expected. But also, what was interesting for me was the inflation expectations. They actually upped that for next year, with a lot of people talking about inflation expectations easing. I thought it was interesting that the central bank there is actually pushing up their forecast for next year and giving some quite high predictions for the next couple of years as well. So clearly, that's the main driver in terms of equities at the moment.
And Andrew, when it comes to this bond market, it is another tough day for European bonds. We're looking at, again, as I was pointing out, yields, especially in Italy, popping up yet again, more so than Germany. You write that fixed income, it's going to have a comeback after a rough 2022, but can it come back for this European market with an ECB who is unapologetically hawkish?
Well, it was surprising how hawkish Lagarde was yesterday, but I think when you step back and look where the European economy is going, clearly the energy price shock has been significant. Most of the indicators are suggesting that Europe is not already in recession, it's heading in that direction. So I do feel that to some extent, Christine Lagarde is talking quite a big game because she's trying to manage inflation expectations. But the reality of where the European economy is going may mean that potentially the deposit rate may not get much above 3%, which is still quite tight policy by European standards. So I think we're not quite yet at the end of that interest rate adjustment, but I think as we get into early 2023, that will come into view.
How are you viewing then the euro? Because it's stronger today, it was weaker yesterday, but you could have said that, look, this interest rate differential play, Andrew, was one that would benefit the euro, that the ECB, they're unrelenting, maybe the Fed will relent. Is that story going to come to fruition? Is it going to be a weaker dollar, stronger euro in 23?
I think it can be. The interest rate differential story is only part of it. Clearly, the euro is one of the most undervalued currencies around, probably second only to the yen, relative to its long-run purchasing power parity valuation. But the story of the euro and every other currency is going to be what happens to the dollar over 2023. It's been in this massive bull run since the financial crisis. If we get a relatively mild recession in the US, or even just a soft landing, I think that may be the most dollar bearish outcome, which would be bullish for the other currencies. But beyond that, a recession in the US, a bad recession, I think would be dollar strong, euro bearish.
I mean, the shape of this recession, it's something that we debated all 2022. We're still debating it here in December. Joe, to what degree is a recession priced into this European equity market?
Well, I think European equities are cheap, but I don't think they're hugely cheap. I think the Stock 600 trades at about 15 times earnings, and I think that it might get cheaper when earnings estimates come down as we go into probably the following two earnings seasons. Earnings estimates will have to come down again. But I think in terms of the recession, I mean, one thing I would highlight is I think that central bankers are very divided across the regions. And the thing that stood out for me yesterday was the two Bank of England members who voted for no hike at all. They voted to keep the rates as they were. They've not quite gone full. Danny Blanchflower, I think, wanted the BOE to cut rates. They've not gone that far, but it's just a sign of how much uncertainty there is among central bankers at the moment.
Right, there's that uncertainty among central bankers. But Andrew, from where I'm standing, I see strategist after strategist say a recession is coming. Things are coming worse for stocks. Even Marko Kolanovic over at JP Morgan, who had been extremely bullish, is finally saying that stocks will fall in the first quarter. Is that not a really bullish sign that everybody at this point sees stocks falling, sees a recession coming?
Well, it's an interesting point, isn't it? Because this, if it happens, it will be the most forecast recession ever, and everyone knows that economists in particular have a terrible track record of forecasting recession. So we have this tension where the economists are expecting recession, but the earnings numbers aren't at recession-like expectations yet, and that's why people are saying that there's more downside. The one thing I'd say, our process, we look at a lot of sentiment indicators because sentiment tells you where the psychology of the market is. We've had two major panic points in 2022. Psychology is still quite nervous, and that actually gives the market a bit of a bottom. So there is still the chance that markets once again confound expectations by not falling as much as the pessimists would argue they should.
Andrew, you also seem more optimistic when it comes to 60-40, who, let's be honest, the strategy had a very tough year. Walk me through your thinking there. Why does it come back?
Yeah, I think the bigger picture is we always have to think about these things in the longer term. One thing we know is that markets and economies move in cycles. 2022 was probably the worst year for your classic 60-40 portfolio since the early 1970s. I can't remember a year in which we've seen big losses in both, double-digit losses in both equities and fixed income at the same time. The odds of that happening again are fairly low, but more particularly, 2022 was the year of the interest rate reset. We've now gone to a point now where interest rates, particularly long-term government bond yields, are back within their normal valuation ranges for most regions. And that's important for thinking about, firstly, fixed can be a diversifier for equities now. That's good for 60-40. And also fixed can now start delivering the normal types of returns that you expect from that portfolio.
So finally, the normality might be returning to this market. But Joe, does the normality extend to this idea that bad news is bad news? We had some ugly U.S. eco data yesterday. Retail sales come in weaker. Bonds got a bid.
Yeah, I mean, I think the data obviously this week has been, pretty negative overall. If you look at, we had obviously the US inflation data sort of kicked us off, and if you look at the dollar, I think the dollar is pretty much unchanged on the week. And I think that, as you mentioned, the data is not looking great. The retail sales today was expected to rise, and we saw a decline of around 0.3% on the month, I think. And that's even after government support for households on things like energy, and with Christmas coming up. So the macro picture is obviously really poor at the moment. And as I mentioned, I do think that earnings estimates coming into the next 2 quarters will have to come down significantly, and therefore you could see more downside in equities.
Okay, Joe, thank you very much. Joe Easton there from our Bloomberg equity team. Andrew Pease, Russell Investments Global Head of Investment Strategy. Thank you so much, both of you, for joining us this morning. I want to bring you a breaking line on Mazars, the accounting firm. It had been hired by Binance, but Binance now says that Mazars is pausing all work for crypto clients. Again, they hired them in order to help verify their reserves, their token reserves. This is a concern for many investors, for many exchanges after the FTX drama. But again, Binance saying that Mazars is halting their work with their crypto clients. Now, coming up on the show, Beijing's sudden pivot away from COVID-0 is confounding observers, who says the move carries enormous risks for China. More on that story next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Beijing's rapidly spreading COVID outbreak has turned the Chinese capital of 22 million people into virtual ghost towns as stores close and restaurants empty. It underscores the cost of President Xi Jinping's sudden pivot away from COVID zero. Joining us now is Bloomberg's Alan Wan. Alan, what is the mood currently in Beijing? Do things appear to be getting worse with this COVID outbreak, or perhaps better as restrictions loosen?
Well, first, my buddy in Beijing called it a ghost town just because he saw more people out and about before the reopening than he's seeing them right now. But the mood in general has improved by and large after we saw like stark images of long lines at hospitals, shortages of medicine in the pharmacies, and even garbage piling up in the cities of in Beijing. The reason why is I think that one thing is authorities are actually expanding the number of fever clinics. We're getting more antivirals and a larger antiviral supply. Government keeps on making announcements like we're going to get a fourth COVID vaccination and a second booster for the elderly. And I think a lot of people are sort of starting to accept the fact that they're likely to get it, given the fact that a lot of their friends and relatives already have it already. But that said, I think the mood could change depending on deaths. Right now, we've only seen 2 reported deaths since the start of this month, and it seems like it's underreported, given the fact that in Hong Kong earlier this year when they reopened, we saw a lot of people, a lot of deaths, especially elderly and unvaccinated people. So that's sort of like the analogy a lot of people are making. But I think we'll probably know more in the first quarter of next year when we'll reach the peak of this current wave of people who are sick.
What about the economic outlook? Of course, we have Chinese officials gathering for a blueprint for the economic outlook for China, targeting 5% or higher growth. How have forecasts coalesced around China, around its wider eco outlook?
You know something, I'm surprised that analysts aren't getting whiplash from all these changes they've had to make since the start of the year. I mean, right now you have UBS and ANZ. They're revising down their forecast for this year and revising them up for next year just because of the spread of COVID. I believe UBS is cutting their forecast for this year to 2.7% and raising it for next year to 4.9%. To be honest with you, making these kind of projections aren't very difficult right now, given the slate of poor economic data we've been seeing over the last few months. Not just the headline numbers, but even the high frequency data, stuff like traffic congestion, travel between cities, consumer sentiment. They're all down from a week ago, and we're seeing no pickup in other key areas, just like consumption. We're spending on cinemas and hotels. Just isn't happening right now.
Right. Okay, Alan, thank you very much for the update. That's Bloomberg's Alan Wan in Shanghai. Coming up on the program, SocGen CEO doesn't see a need to follow Wall Street's recent job cuts. That's even as the French bank intends to remain prudent on costs. We're going to have more from our exclusive interview with Frédéric Oudéa next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. SocGen's outgoing CEO says he doesn't see a need to follow Wall Street's recent job cuts. That's even as the French bank intends to remain prudent in costs. I spoke to Frédéric Oudéa in Paris at the sidelines of a conference. Take a listen.
I think we are seeing at this stage some signs of slowdown of the pace of inflation. I'm sure that the central banks will carry on monitoring all the parameters on the economies to calibrate rightly their monetary policy. What is being done is needed. But again, I don't think that we are facing the same kind of scenario. There is a lot of uncertainty. External shocks can create the problem.
Right.
Let's face it. But in the absence of an external shock, we are have in mind a slowdown, but which is that we can absorb.
So what sort of shock are you concerned about? What would hit the level of changing things for you to erase that optimism?
Geopolitical crisis, an evolution of the conflict in Ukraine. But just if you wish, the way we will fare the winter and effectively with perhaps hopefully temperatures which are okay, which will mean reserves, gas reserves being preserved as much as possible will help for the next 12 months in terms of gas prices. So there are many parameters which can play a role in the inflation. Wage evolution also. At this stage, I see also companies which are trying to avoid entering into a cycle where wages are increasing too much. So they want to preserve the future. So again, every month we will see how it goes.
The wait-and-see approach from SocGen CEO there, Frédéric Oudéa, who of course is leaving in May 2023. Let's now get to the Bloomberg First Word News. With that is Leanne Gerrans. Good morning, Leanne.
Good morning, Danny, and thank you. EU member states are said to have reached a deal on a 9th package of sanctions on Russia. The measures will target Moscow's access to drones, more Russian banks, as well as officials responsible for allegedly abducting children from Ukraine. The package will impact more than 100 individuals and dozens of entities. Now, Slovakia's government has been toppled after its ruling coalition lost a motion of no confidence yesterday, initiated by the Freedom and Solidarity Party, who withdraw from the government in September. The vote deepens a political chaos where months of infighting has hampered legislation and makes a snap election more likely in a country with pro-Russian opposition leaders. Pubs and restaurants in London that survived COVID are now facing another threat. Persistent trade train strikes. Restaurant seatings on the first day of rail strikes this week collapsed to levels not seen since Omicron, when face masks were compulsory on public transport and the government was telling people to work from home. Earlier this week, office occupancy in the capital fell to around 20% compared to more than 50% at times before the strikes. And U.S. House Speaker Nancy Pelosi and Senate Majority Leader Chuck Schumer have told CNN that Joe Biden should run for re-election in 2024. The 80-year-old U.S. president is the oldest person to ever hold office and faces Democrats calling for a younger generation to lead the party. Biden has said he is likely to run again, but will make a final decision by early next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. Leanne Gerrans here in London. A quick check-in on the European sovereign bond market because the sell-off is deepening after yesterday's. You're looking at another 20 basis points or so of gains in Italian 10-year yields. That puts the total two-day move at about 50 basis points. We're also looking at German 10-years. Those are moving higher by about 10 basis points. So we had a hawkish ECB yesterday. The hawkishness continues today. Mueller saying that they can't rely on economic slowdown curbing inflation alone, and rates are likely to rise more than the market expects. Also falling this morning is Bitcoin, down 2%. This falling after those headlines we discussed earlier of the accounting firm that Binance had hired. They are no longer going to be working with crypto firms. There was concern over Binance and really the entirety of exchanges of proving they have the reserves to back things up. The accounting firms were supposed to help them do that. So fear right now in these markets. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Hawks ascendant, the ECB follows the Fed with a 50 basis point hike, but over a third of the Governing Council were said to have pushed for 75. Stocks move lower. The EU backs a ninth package of sanctions against Russia for its invasion of Ukraine. The U.S. hits the nation's richest man with penalties, but spares his company, Norilsk Nickel. Plus, PMI surprise, the euro area manufacturing downturn is easing as supply chain snarls abate and inflation slows, signaling the bloc's economic slump will be less steep than feared. Well, you made it to Friday after a week that has been very eventful. It's been a very eventful 48 hours that has seen continued hawkishness from central banks, perhaps less so from the Fed. Not too many surprises, though, of course, the dot plot did show us the terminal rates might be above 5%. The real surprise did seem to center around Christine Lagarde and the ECB, a series of 50 basis point hikes. Madame Lagarde was clear to say there is no pivot coming, and we continue to see sovereign bonds sell off today. Now, we're also getting some flash PMI numbers in, this time from the UK. We're looking at manufacturing coming in weaker, 44.7. The forecast was 46.5. Services, those are stronger. This is a similar story, I must say, that we saw to Germany. UK services coming in at 50. The forecast was 48.5. So a bit of a patchy story there. I should say in France it was weaker all around, but we are seeing some strength for both Germany and UK when it comes to services. Now let's pivot a little bit from Europe to China. Investors are awaiting any news from China's Central Economics Work Conference, which Bloomberg sources say were scheduled to begin on Thursday. Observers expect President Xi Jinping and his officials to flesh out policy objectives for the coming year. For more, we're joined by Ginny Yan, head of China strategy at ICBC Standard Bank. Ginny, great to see you. Thank you so much for joining. Look, it's been a bumpy reopening, to say the least, considering there are now fears of more COVID cases, people staying in. How are you thinking about China and its economic trajectory as it backs away from COVID zero?
Look, I think with all of the economies, particularly major economies opening up, we are expecting that bumpy roads where essentially logistics needs to recover. And at the moment, as yesterday's data print confirmed, the fundamentals are very much lagging the market sentiment. And of course, this quicker than expected opening also means that corporates need to start to think about their inventories, have they oversupplied, etc. So all of that means that up until probably March, which is when the two sessions happen, a lot of adjustments needs to take place. So a refinement in terms of expectations by investors are necessary in the coming weeks.
How should we adjust our expectations in, once we finally get to see some of the benefits, what that will actually look like? Because to some degree, it's our bias of living in the UK, where we had massive stimulus, or in Europe or in the US, makes us think that, okay, perhaps China sees that. But of course, they didn't undergo the same stimulus drive that the US and Europe did. So what will reopening actually look like? Do we need to reset our expectations there?
Well, with China, what's different is that stimulus has been in place for the entirety of the 3 years. Accommodative monetary policy, fiscal policy, all these additional fiscal measures that were rolled out. And recent voices from Beijing is very much confirming a continued supportive policy measure coming out in the next few weeks. So whether it's the property sector, whether it's continued boosting of consumption, this is what we're going to expect. So for sure, we will probably get some revenge spending, for example, from households, as long as this current wave of COVID is being digested. So I'm positive. I think that China has been relatively resilient despite the headwinds and will continue to be resilient. But what we need is clear evidence that that turning point has come, and we await that data.
Will we likely see with China, again, the same trajectory that the West embarked on, of if it starts in the goods sector and then it moves to services?
Yes, That's right. Well, China, as we know, is already transforming into the services sector, high-end, innovation-driven economy. That's exactly the types of sectors that will receive the investment. And for sure, all of that will be nurtured. But of course, what we're struggling in the meantime is the catch-up of the logistics industry. And that's what we're hearing, ensuring that logistics are caught up, supply chain disruptions are minimized. So a focus on domestic consumption is very important for 2023.
Does that mean things like cracking down on big tech's hold, too much leverage in the property sector, these sorts of, social stability and fiscal prudent projects, do those then need to take a backseat for the expense of economic growth?
Good point. However, I think the overall theme of common prosperity means that no one loses out. So there will not be a targeted crackdown on certain industries. Even the property sector, tech industry, they will all benefit. But what's going to be key is that everyone benefits. So reducing inequality, making sure that everyone, including and especially the working population, benefit out of the current and incoming bout of stimulus and recovery.
How important is foreign investment in all of this, in the road to recovery for China?
Well, I think foreign investment has always been important. Not only, of course, that direct investment, portfolio flows. We're seeing more and more investors very much attracted by China opening up to more foreign investors. So China's growth story should only encourage more investors. And that stability is very important. We see it from, for example, Chinese government bond yields. Despite the headwind, the bond yields have remained relatively stable. And with that turnaround, I'm sure that yield inversion with USTs may also see some positive trajectory. So what I think is that both portfolio and FDI direct investment may will continue to be kept in China, but also come back to China as we see fundamentals improve.
For that, how important is the geopolitical story? We made a lot of President Biden and President Xi talking. There had been concerns before during Russia's invasion of Ukraine that perhaps China sides with Russia and isolates itself. That geopolitical aspect to the story, how necessary is it, again, to make sure that the foreign investment in general comes in?
Well, I think Beijing is very aware that geopolitics comes into a lot of that, particularly with its largest trading partners. But we're seeing some improvements in terms of the sentiment, mainly that there needs to be a constructive way to move forward. We're seeing that with the US, we're seeing that with the UK, we're also seeing that with Europe. So lots of bilateral visits, which are upcoming, will help matters. And I think that's, very much to be welcomed by markets.
Okay, Jenny, I'm afraid that's all we have time for. Thank you so much for joining us. Jenny Yan, their head of China strategy at ICBC Standard Bank. Enjoy your holiday season, Jenny. Coming up, don't miss our interview with Nico Stathopoulos, chair of Europe at BC Partners. We're going to talk private equity. That's next. This is Bloomberg.
Digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's
doing
weird.
like a weird floaty thing right now. But
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Now let's talk about private equity and how it's faring amid soaring inflation and fears of a global downturn. BC Partners has $41 billion in assets with a focus on private equity, credit, and real estate in Europe and North America. And I'm very pleased to say that joining us now is the chair of Europe at BC Partners. It's Nikos Stathopoulos. Nikos, thanks so much for joining this morning. So look, we are meeting the day after an ECB where it feels like, at least on the public market side, everybody is gearing up for recession. Bond yields are moving higher, stocks are selling off. And what you see, the many companies in Europe that you interact with, are those fears of recession founded?
Well, first of all, thank you for having me again. I think there's no doubt inflation is there, interest rate hikes are there, and I think the fear of a recession is also there. I would say the fundamentals of our companies remain very solid. What we've seen in the key indicators, the balance sheets of companies remain strong, the labor market is strong. So overall, for now, we're not seeing that recession, but I think we're bracing ourselves, especially in the European side, and certainly in this country, where all the expectations is that the impact of food, energy, interest rates, etc., will impact the business. So we're bracing ourselves for that.
What does it look to brace for a recession? How do you prepare for that and prepare your portfolio companies for that?
You make sure that your cost structure is in a way that you actually can sustain a drop in on the top line, on the revenues. You try to see if there's anything you can do on pricing and try to help grow that top line, because that's important. But mainly, it's all about protecting the margins, protecting the cash flows. So in the event that the recession hits, or if it's stronger than it's expected, then that you are effectively protected on the downside.
So do you have to have some pretty tough conversations with founders at this moment then? Things like, perhaps you want to trim back on staffing, on bonuses. What are those conversations like right now?
We're having tough conversations with our management teams and with the CEOs of our companies, because, of course, when they prepare their budget for next year, they themselves, of course, are not sure how the world is going to look like. So, yes, we have to have some buffers when it comes to staff costs, as you correctly say, wage increases, which are inevitable in an environment of inflation,
right.
And anything else that we can have in order to make sure we maintain the cost structure as lean as we can.
Do we need to think about Europe's business model differently? And I ask this because, yes, it's been a mild winter. The energy crisis hasn't been as bad as many people had feared, but so much of Europe industry was dependent on cheap energy sources from Russia. If that's gone, does the competitiveness of corporate Europe, does it take on a different form?
It's undoubtedly the energy costs are higher, and we're forecasting higher also energy costs for next year. I think the competitiveness, unfortunately, has been impacted for Europe, and we see it more exactly as you say in our European portfolio than in our US portfolio, where Europe has been harder hit by the energy crisis. How sustainable it's going to be and how long this is going to last, we don't know, but certainly for 2023 and maybe even for 2024, we're expecting higher energy costs. Some of our companies have hedged their energy costs, and that has benefited them. But I think the expectation is that Europe will be hit harder.
I know when we last talked in summer at the Super Investor Conference in Berlin, we talked about this idea that the valuations, any of that fall hadn't exactly shown up yet because there was this hesitance to actually sell in what's a difficult market. Has that shown up yet? What do valuations look like for the industry? Are they, again, under as much stress as this public market is, for example?
So valuations have come down. The interest rates increases by definition recognition have resulted in valuations coming down. We've seen it more in the public markets so far than in the private markets. You've seen the S&P 500 being down almost 15% since the beginning of the year. Even Euro stocks as well has been down. We've seen PE multiples coming down between 4 and 5 turns in the public markets. They haven't yet translated exactly the same in the private markets today, but we are definitely seeing valuations coming down.
What does that mean for deal flow? Are folks still hesitant to actually sell again and crystallize that sort of loss?
They are. So a lot of that's why you've seen also the deal activity, especially private equity activity in 2022 being down more than 30%, because the sellers are sort of holding back for now because they don't want to sell in this environment. Buyers are still willing and able to do so, but you need both a seller's market as well. So the activity has been more subdued. Financing has not helped that either, because financing markets have been effectively shut. So people,
what do you do then? I mean, if you want to do a deal and you need financing and you can't turn to a bank, what's been the alternative?
The alternative has been private credit. So if you see universally in 2022, most of the deals that were done have been financed with private credit. In some cases, you've seen some seller financing, some vendor loans. You've seen also minority deals happening so that there's no change of control and you don't need to refinance the debt. But private credit has been effectively the savior of the day. It's more expensive, but it has longer maturities and it has no amortization, and effectively has been the only way today we could have financed transactions.
Nikos, it is a tough environment you're describing, talking about companies, proofing them for a recession. Financing is difficult. But when you think about 2023, are you optimistic, Nikos?
I am, actually. I am optimistic because I think inflation seems to be peaking. I think the central bank monetary policies seem to be, and I suspect it will cool off. I've also seen in similar periods of distress, like post-Lehman, for example, that quasi-closure did not last very long because the markets cannot afford to be closed for too long. The system cannot afford to be functioning, not to be functioning for too long. Banks need revenues. Investors need to deploy capital. And I've seen, as I said, the fundamentals, the key indicators of businesses and markets are there. You know, balance sheet is strong, labor market is strong, the capital markets are orderly, and there's a lot of liquidity in the system. So I would say pricing risk in this environment remains very difficult, and it needs that conviction and discipline. But I think in these times of uncertainty, we've seen in the past that the best opportunities come through. And also the fact that we've seen that both public and private markets have been very resilient. So yes, I'm optimistic.
Well, given that perhaps some folks out there are overly doom and gloom, valuations are coming down, where specifically are you seeing opportunities then that perhaps are underpriced in this current environment, if it is going to get better next year?
I think we'll see opportunities, I think, in the more resilient sectors that we've seen in the past, like in healthcare, for example, or in telecoms, sectors where they've been sort of downside protected. Probably less so the sectors that are more directly exposed to consumer, because the consumer has been hardly hit and most likely will continue to being so in 2023. But again, sectors where we feel that resilience is there and that downside protection is there, because that's the only thing we can bet on today.
Because 1 week away from the holidays, we need that bit of optimism. Thank you for bringing it to us, Nikos Stathopoulos, Chair of Europe at BC Partners. Now let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Good morning, Danny, and thank you. Twitter has suspended accounts of upstart rival service Mastodon and several prominent journalists covering its billionaire owner, Elon Musk. Late last night, reporters from the Washington Post, New York Times, and others were listed as blocked, with Musk calling the posting of his real-time location basically assassination coordinates. The standard Twitter ban for disclosing personal location information, also known as doxing, is actually 7 days. Now, China is said to be consolidating purchases from about 20 of its largest steel makers in a new single state-owned company. The move marks the biggest change to the global iron ore market since 2010. The company, called China Mineral Resources Group, will use its buying power to secure discounts as soon as next year. The Philippine Central Bank has raised its benchmark interest rate to a 14-year high, joining others around the world attempting to crack down on inflation. In an exclusive interview with Bloomberg TV, Governor Philip Medela told us that more tightening is yet to come.
Our own forecast is that inflation will be back to 2 to 4% by the third or fourth quarter of next year. So in other words, what we have to do is do more to make sure that that happens.
And about 200 Chinese companies no longer face an imminent threat of being booted off American stock exchanges. The U.S. Public Company Accounting Oversight Board says its inspectors have been able to sufficiently review audit documents from firms listed in the U.S. The announcement came after recent inspections by the board in Hong Kong, which was a major breakthrough in the long-running dispute. And that's your Bloomberg Business Flash. Danny.
Leanne, thank you so much. Now, coming up on the program, we are just 2 days away from the World Cup final, and the excitement among the fans is reaching a fever pitch. We're live in Qatar next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then they trade you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
The secret success of any company is to grow. And I think that we, WPP, and our industry more broadly, can be really at the heart of a client's growth. You know, how do they succeed with consumers? How do they reach them in new areas? How do they innovate? How do they create new brands?
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Crypto is falling this morning. Bitcoin is down 2%. Mazars, an accounting firm that's done a lot of work with these firms to do these so-called proof of reserves reports, is pausing all work for crypto clients. This, according to Binance. The spokesperson from the company also saying that they're pausing work with Crypto.com, KuCoin, and again, Binance, as I mentioned. They have been at the forefront of this idea of publishing these proof of reserves reports. They have seen scrutiny in themselves because it might not be as robust, as thorough as some would like to make sure these crypto exchanges have the reserves to back up client money. Now, from Bitcoin to football, we are just 2 days away from the World Cup final in Qatar, where Argentina and France will face off for football's ultimate prize. My co-anchor of Bloomberg Daybreak Europe, Manus Cranny, is at the Lusail Stadium in Qatar, where the final will take place on Sunday. Manus, I've been watching you. You've been practicing your game. You've been practicing the headers. You are ready in case Messi goes down and the coach needs someone. Manus, oh my God, you're on fire, Manus.
We're going to get rid of that for the moment.
I was hoping you'd do another header, but we'll save the camera person over there so you don't knock him out. All right, Manus, give us your breakdown. I mean, look, you are there in the tiny Gulf country of Qatar. How has this tournament changed things?
I think the world has suddenly realized where Qatar is. They certainly know where Saudi Arabia is after the oil debacle between the White House and the House of Saud. But record viewership, record spending for FIFA. FIFA's going to earn $7.5 billion, we reckon. Many people traveled to Dubai and hubbed over in shuttle flights here to Qatar. But there's certainly, I mean, if you want to understand what $45 billion gets you, it's this. We're at Lusail Stadium. This is where the final will be. They've spent $300 billion. If you're going to do a big trade, look big, look large, and make an impact. 8 stadiums, some of them reusable, but they are gargantuan in their presence. In terms of did they get the numbers over the door, 765 million arrived in the first couple of weeks. That's a lot less, 40% less than we'd expected. But I think the world certainly knows where Qatar is for lots and lots of reasons, for good and for bad. Danny.
Manus, we only got a minute here, but I know you've been tracking where terminal clients think who's going to win. Come on, break it down for us. Who's got the advantage on Sunday?
You got W Cup Go. You can hop on there. I mean, there's no doubt about it. Lionel Messi is a phenomenal. There was that imagery of his head in his hands when Saudi Arabia trounced Argentina, and then he went on to score 5 goals in this tournament. World Cup Go gives you the odds. Argentina incrementally ahead of France because Brazil got knocked out. So the odds have shifted, Danny. But I think when it comes to spend, and in soccer, by the way, soccer, not football, the most watched match ever in the United States of America was England-USA. So if you want impact, there you go.
I was going to say, I was in those numbers. I was watching it very closely, Manus. I mean, speaking close to my heart, calling it soccer instead of football. I definitely appreciate it. All right, Manus Cranny there outside the Lusail Stadium. This is Bloomberg.
Somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful on society?
Well, I think the first thing you've got to believe in something that you really care about. You know, I've been fortunate that over the course of my career, I've come up with things that have mattered to me, and I've pursued them. You know, the best advice I ever got was from Mike Bloomberg. And he said to me at one point, he said, show me somebody who's never lost, and I'll show you a loser. And I believe that if you believe in something, go after it, take risk. Obviously, they should be smart risks, but they should be around things that you really care about.
So you would see your legacy as being actually target ALS and helping to moderate the impact of ALS, if not curing it.
That's my final legacy. I'm proud of some of the other stuff that I've done as well. Transformation of New York after 9/11. I'm also incredibly proud of a lot of the companies we created at Sidewalk. But I feel like I've done a lot.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions.
We believe that the market has run ahead of itself.
It's a real winter of discontent at the moment. Central banks have kept interest rates too low for too long.
We're now transitioning to this environment where central banks are divided.
In some respects, I think the Fed's been dealt a better hand than the ECB.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Rough week for equities. U.S. futures drop along with European stocks as investors around the globe price in more rate hikes and grow increasingly worried about recession. The latest COVID outbreak turns Beijing into a ghost town. It could be a preview of what's next for the rest of China as it moves on from COVID zero. And the European Union targets Russia once again. It signed off on a 9th package of sanctions targeting banks and drones. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kaylee Lines in New York. Matt Miller is off today. Well, the sober reality of the hawkish rhetoric really hitting risk assets this week, Kaylee. We continue to see that here in Europe and into US futures.
Yeah, it hasn't been a pretty week, and it doesn't look like the week is going to end on a pretty note either. It definitely didn't in Asia overnight, Anna. You actually had the MSCI Asia Pacific Index snapping 6 weeks of gains with a loss of about 0.75% today, which makes it a weekly loss as well. What was actually leading the decline was Japanese equities overnight. The Nikkei was down about 1.9%. Maybe part of that having to do with the Japanese yen gaining some strength back. Could be a little bit of a bid for safe haven there. Also bets on perhaps a policy pivot coming from the BOJ next year. But dollar yen down against the yen by about 0.4%, trading at 137.20. That is actually your biggest outperformer in both Asian and G10 foreign exchange. Meanwhile, the Chinese yuan also slightly stronger against the US dollar. But of course, in China, they are dealing with a rapid outbreak of COVID-19 in big cities like Beijing, due to the really rapid easing of restrictions that's resulting in a lot of infections. Right now, dollar offshore yuan trading at 6.98. Meanwhile, here in the U.S., we do look set for a 3rd consecutive day of losses when it comes to U.S. stocks. S&P 500 futures right now down about 1% after a 3% loss over the last 2 days after the Fed policy decision, of course, really weighing now concerns about a recession that may be forthcoming. In the bond market, we're up 4 basis points on the 10-year yield, right around the 3.48 level. And keep an eye on oil as well. We had 3 strong days to start the week, so we could still see a very slight weekly gain, but WTI futures are down about 2.5% this morning, trading at $74 a barrel. Again, demand concerns, really what we're watching there. And then I wanted to point to Bitcoin as well. You have a lot of contagion concern when it comes to exchanges that may or may not still be healthy, of course, in the wake of FTX. Now the concern surrounds Binance, which has been pressured to publish proof of reserves that it can back customer assets one for one. It said that its auditing firm that was working with Binance now is no longer working with crypto clients. So that seems to be weighing on sentiment broadly in the crypto universe. And Bitcoin right now down 2%, trading right above $17,000.
Yeah, that audit firm no longer working with any crypto clients, as you point out, Kaylee, which is an interesting development. This is what we see on Europe right now. A worsening picture, really. We have European stocks under pressure, down 0.5% on the FTSE 100, the CAC down 0.9%, the DAX down 0.7%. In fact, only one sector has really been in positive territory for any long period this morning, and that is around the banking sector. So that higher rates environment that spooks other assets, perhaps actually benefiting the banking sector. On that note, we've just had some Euro area final reading on CPI, the November core CPI rising 5% year on year. The estimate was for exactly that, an increase of 5%. So that's broadly in line. If you look at one of the other data points, though, we've got a number that starts with a 10 and actually 10.1% versus an estimate of just 10. So maybe not moving in the right direction on that European inflation story. Certainly the Italian final number coming in a little bit higher than had been anticipated. Only 1/10%, but it's those kind of moves either side of expectation that can spook markets a little bit. But do we see much movement on the euro? A bit of a movement in the euro as a result, but 106 is pretty much where we were trading prior to that data hitting. Some interesting PMI numbers coming out from Europe a little bit earlier on, Kaylee, and they painted a picture of maybe the pace of deterioration in Europe moderating, and so that's a sort of better story, if you like. The pound at 121.44. Yesterday, of course, we saw the strength of the dollar certainly to the fore. The pound lost ground as a result. Today, we've got PMI data out for the UK, which shows that the manufacturing sector is really weak. A 44 handle on that PMI for that sector. The services sector doing a lot better, up at 50, but perhaps that creates headaches for the Bank of England. The Italian 10-year yield, I put this in here because we continue to see another day where European yields are on the rise. It's not just Italy, it's France, it's Germany, it's the UK as well. That hawkish rhetoric we heard from the ECB yesterday having a widespread impact, it would seem. And I put this one in here as a stock story to keep an eye on. It is a global story as well as being the largest gainer on the stock 600 this morning, up 16% then for Games Workshop Group. It makes those tabletop games, those sort of war role-play games, Kaylee, that either you are familiar with or you're not. And basically, they've done a deal with Amazon, and that deal means that Amazon is going to make TV programs and films around their intellectual property, and that, it seems, is good for that stock.
Yeah, so good for at least one stock today, Anna, but broadly, of course, stocks are lower. It seems that risk sentiment just not really able to hang in there after a massive week for central bank rate hikes, as well as weak U.S. economic data. That is what sent stocks plunging yesterday, and that is continuing this morning. Nadia Level, senior U.S. equity strategist at UBS Global Wealth Management, spoke with Bloomberg yesterday on what she sees this market pricing in.
We don't think a recession is priced in. I mean, much of what you've seen this past year has been the market response to higher rates. The pullback that you're seeing in the market today, we aren't surprised by it. Remember, this is a market that has been traded on hope of the Fed not doing what they say they would do. But yesterday's dot sent a clearly different message with 17 of those dots above 5%. And so the risk is skewed to the upside.
Valerie Teitel, Bloomberg Markets reporter, is joining us now for more on the week that was. Valerie, we knew it was going to be a big and possibly volatile one, and it turned out that way.
Yeah, let's hope it's the last exciting week of the year. I think I've had enough in 2022. But I want to talk about the data yesterday and the reaction of the equity market. We had that weak retail sales print, and equity markets fell. And why do I want to talk about this? Well, for most of the year, strong economic data has been denting stocks. That's because the stronger the U.S. economy is, the higher the Fed has to go, the higher yields go, and the weakness in stocks because of that. And we're now seeing a decent flip. Yesterday, the retail sales number dented stocks. We also had weak manufacturing data coming out of the U.S. And if we look at it back on the week, we can think maybe this correlation is back. Stocks trade lower and bonds are bid, treasuries rally, yields are lower on the back of that. And we can say, whoopee, this correlation might finally be back. It's been a rare year in markets that we've had both of these assets falling together. But look, as we look ahead to next year, this correlation is going to be flipping, and it might be flipping meaningfully. We're not going to be staring at higher and hotter inflation data that spurs yields higher. Instead, we might be focused on weak data, the U.S. slowdown, weak equities, and bonds are bid on the back of that. And maybe we might be jumping for joy that this correlation might finally be done.
Okay, something to watch. Valerie, thank you very much. Bloomberg's Valerie Teitel getting perhaps excited that we get towards the end of the year. Now, let's talk about what's going on in China and the pivot away from COVID-0. Beijing's rapidly spreading COVID outbreak has turned the Chinese capital of 22 million people into a virtual ghost town as stores close and restaurants empty. It underscores the cost of President Xi Jinping's sudden pivot away from that COVID-0 policy. Joining us now is Bloomberg's Alan Wan. And Alan, what is the mood like then in Beijing? I mean, this just underlines the difficulty that the country is going to have in moving away from COVID-0.
Well, I have a buddy in Beijing. He's been calling the city a ghost town because he's seeing actually fewer people out and about now than before the reopening. But by and large, the mood has calmed a bit since last week when we saw stark images of long lines at hospitals, empty shelves in pharmacies, and even garbage piling up. I mean, what's helping, though, is that there's been a rapid expansion of fever clinics, increased supply of antivirals, even soothing statements from the government, including one where they're prepping a fourth COVID vaccination and a second booster for elderly people. But a lot of this could change depending on deaths. Okay, right now we only have 2 official deaths since the start of the month. It sounds a bit underreported, given the fact that in Hong Kong we saw like a wave of deaths, especially of elderly unvaccinated people right after reopening. So we're going to have to wait and see, but we'll probably know more after this current wave ends in the first quarter of next year.
Well, Alan, as you talk about massive cities that look like ghost towns, that is not a great signal for economic activity. I know we have had a few firms adjusting their China growth forecast. What is the wider economic outlook here?
Well, I'm surprised analysts aren't getting a whiplash from all this. They keep changing their forecast since the reopening. This time you have banks like UBS and ANZ. They're actually cutting their forecast for this year and raising them for next year because of the spread of COVID. I mean, I think, well, UBS anyway, it's cutting 2.7% this year and raising to 4.9% next year. But it shouldn't be very surprising that they're doing this just because we've had so much lousy economic data over the last few weeks. Not just in terms of the headline data like industrial output and GDP, but even the high frequency data such as traffic congestion, travel between cities, consumer confidence. They've all dropped this week. And it doesn't look like things are going to improve, especially in key areas like consumption, where we see no pickup in terms of spending in cinemas and hotels right now, which shows that a lot of people are avoiding crowded places.
Yeah, Alan, really interesting reporting. Bloomberg's Alan Wan there just underlining the fact that it won't really be a straight line to a kind of living with COVID reality in China. Let's get back to Europe. European leaders meeting in Brussels, and they are said to have agreed to a new package of sanctions on Russia. They also urged European energy ministers to complete a deal on a price cap on natural gas as soon as Monday. For more, let's go to our correspondent Maria Tadeo, who's in Brussels for us. What was agreed then last night, Maria? A 9th package of sanctions, is that right?
Yes, and Anna, this was a final meeting for the year. A lot of the agenda I would know because I was working until midnight on this thing, and a lot of things, in fact, were approved and got green-lighted yesterday. Yes, you do have the sanctions. They target more Russian banks. They target more Russian individuals, but crucially, this is about the drone sectors, the export ban on technology that can help Russia with drones. Remember, right now, the fight, this is a drone warfare, what's going on in Ukraine. On top of that, you had the green light to the 18 billion euro financing for Ukraine in 2023. Although we know the criticism from Ukrainians is that the European Union promises a lot on paper, but is very slow on the cash out. And then finally, and you alluded to this, a political message, but this was really a massive political message from European leaders that come Monday, there needs to be an energy deal agreed by ministers, that this cannot wait until 2023. They cannot drag it. You have to get it done on Monday.
Well, on that subject of the energy deal, Maria, we heard from the chairman of Engie yesterday, who is feeling less optimistic on the prospects of such a deal. Just take a listen to what he said.
Am I optimistic that a solution will appear today? I used to be an optimistic person. In this case, I think the debate will be very complex, and I'm not sure that we will end up with something which, at the end of the day, will have an impact.
Are you worried about European unity in general as these debates go on?
I think what we've seen on the energy field is not reassuring. We've seen the beginning of a fragmentation of the European landscape.
And on the subject of fragmentation, Maria, he says he's worried that that is going to stall an agreement on the price cap. Does Monday look realistic at all?
Look, if you had asked me just to go back to that point, that question 2 days ago, I probably would have agreed with him and would have said no. But yesterday, the signaling, the reporting, the information that we have from that room, the 27 leaders really throwing their political weight to get something done on Monday. They do not want to drag this conversation into 2023. The point now, and this is crucial and it has not been solved, is what is the price cap? Where do you set it? The commission came out with 270 euros megawatt. Some countries suggested it is too high. We now understand the range is going from 160 euros to 220 euros megawatt hour. That is a big question to me. It's not so much the deal, but the price point that will settle this thing. And that, for the time being, there's no consensus on that.
All right, well, we will look for your continued reporting on this. Thank you so much to Bloomberg's Maria Tadeo. Now to another story we're watching this morning, Binance. The crypto exchange says French auditing firm Mazars has paused work for all crypto clients globally. Binance was one of those clients, as it has been pushed to prove it can fully back customer assets. The firm is facing a crisis of confidence following the swift collapse of FTX and a surge in withdrawals that followed that. As for how this is translating into crypto stocks in pre-market trading, obviously Binance not a publicly listed company, but one of the biggest exchanges that is publicly listed here in the U.S. is Coinbase, and that stock is lower to the tune of about 2% in pre-market trading, and other crypto stocks like Marathon Digital are down by about that much as well. It is a much larger move, though, for a company in the health space. Guardant, it released the results of one of its tests for colorectal cancer. The accuracy rate disappointing investors, so that stock is down about 33%, but a company that makes a rival test that is more accurate is gaining off the back of that same news. Exact Sciences up about 18%. And one final stock to watch that is moving higher today is Adobe. It reported results last night that topped expectations. It also reaffirmed its outlook for next year. Analysts pretty positive on what that signals about demand for creative software. As a result, Adobe up about 4% before the bell, Anna.
Coming up on the program, we will speak to Des Lawrence, State Street Global Advisor, Senior Investment Strategist. We will put into context all that we have learned about central banks this week, what that means for investment strategy into 2023. We'll also think about commodities next year. Goldman's Jeff Curry says commodities will be the best performing asset class next year. More from our interview with him. That's coming up shortly.
What happens when China, the largest commodity consumer in the world, the largest oil importer in the world, begins to rebound significantly in the first part of next year? It's going to tighten all of these markets tremendously and put a lot of upward pressure on prices.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What you see in these periods of higher inflation when central banks ease more slowly into the recession is they last longer and the drawdowns in assets are longer. So we'd expect kind of double the normal length of a recession because the Fed's not going to be at your back for a long time. And that's a big deal.
That was Greg Jensen, co-CIO of Bridgewater Associates, speaking with Bloomberg yesterday about recession risk. Joining us now to discuss further is Denitsa Tetskova, Bloomberg cross-asset reporter. So, Denitsa, when we look cross-asset across bond and stock markets, what kind of recession risk realistically is priced in?
Yeah, so for the last 2 weeks, we've definitely seen a big shift in rhetoric. And, all year round, we've talked about the good news being bad news. And now we talk a lot more about, well, bad news for the economy is actually bad news for the stock market. And in bonds, we're actually seeing a different reaction. We saw it this week with CPI. We saw it after the retail sales, manufacturing data. And we're seeing more and more people talk about bonds going back to that traditional role of old safe haven assets. And of course, they still provide good yield. So there has been a lot more interest from investors. If you look at the Bank of America survey, actually, investors are most overweight bonds versus stocks since 2009. And also, they believe the best performing asset next year will be government bonds. So that's quite a significant shift.
Yeah, quite a shift. And we talked to quite a few guests, actually, Denitsa, who talked to us about this, the pivot into bonds as we head into recession fears taking center stage. I wonder how that sits along with the rising yield environment we're seeing post-ECB, but we'll come to that later on with another guest. What about equity funds and what we're seeing from equity fund flows? So with your cross-asset hat on, what do you see there?
Yeah, so this year is to be a very interesting cycle of every few months we see a slight increase in equity allocation to only fall back down a few weeks later. And it's been kind of a cycle of a bear market rally starting from oversold conditions, or maybe we see some good data, some Fed speak, then hedge funds reduce their equity, reduce their shorts, investors buy some equities. And a few weeks later, we see the opposite things. Hedge funds come back in, increase their shorts, and investors just sell the stocks they've just bought. And we saw that this week. We saw the S&P broke below its 200-day average last week, this week below the 100-day average. And we're seeing those gains turning into losses quite fast.
Denitsa, thank you very much. Thanks for your time. Denitsa Tetskova joining us there with the latest on the markets. And for further market analysis, check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up? What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Russia has launched another large-scale missile attack on Ukraine. Several cities have been hit, including the capital, Kyiv. Widespread power outages have been reported. The attack comes a day after a top Ukrainian army commander warned that there is no doubt Russian forces will try to seize Kyiv as soon as next month. A Russian assault in the spring failed. In the UK, consumer confidence is lingering near its record low for an 8th month. That's according to a survey by GfK. The results illustrate the impact that rising prices and the prospect of a recession is having on UK households. The Senate has averted a possible shutdown of the U.S. government. Thursday night, it passed a 1-week funding bill needed to keep the government in business past Saturday. That gives negotiators more time to hash out agreements on funding levels for federal agencies and the current fiscal year. And Twitter has suspended the accounts of several prominent journalists covering the company's billionaire owner, Elon Musk. Musk says they were endangering his family by posting his real-time location. Those suspended reporters include those from The Washington Post, The New York Times, and CNN. And Anna, I have up on my screen here a tweet from Elon Musk back in April saying, I hope even my worst critics remain on Twitter because that is what free speech means. I guess maybe there's a line between doxing someone and exercising your right to free speech, maybe?
Yeah, it seems the posting of people's locations is what he is specifically objecting to. Whether that is, whether he has a correct understanding of what those people did, though, is another thing. Let's get back to the markets when we return. Then, Kaylee, we'll talk with Des Lawrence from State Street. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Rough week for equities. US futures drop along with European stocks as investors around the globe price in more rate hikes and grow more worried about recession. The latest COVID outbreak turns Beijing into a ghost town. It could be a preview of what's next for the rest of China as it moves on from COVID-0. And the European Union targets Russia once again. It signed off on a 9th package of sanctions targeting banks and drones this time. I'm Anna Edwards in London with Kaylee Lyons in New York. Matt Miller is off today as we head towards the weekend here in Europe and towards the US equity session where you are, Kaylee. Sentiment really tough for equities.
Yeah, tough for potentially a third day in a row. Remember, Anna, we're already coming off of 2 consecutive days of losses for U.S. stocks. We're down about 3% over that time when it comes to the S&P 500. And in the future session this morning, the losses are just getting steeper as the session grows older and we get closer to the opening bell in about 4 hours' time. Right now, S&P 500 futures down by about 1.2%. The focus really is on recession risk and whether or not the Federal Reserve is going to continue tightening through that and potentially over tighten maybe. That is really what the market is considering. And that's just not just an equity story, but it is a bond market story as well. So definitely one to keep an eye on. And I know you're going to continue to run us through European assets in just a moment. And I do want to mention, though, Bitcoin is an asset to watch today. We're around that $17,000 level still. So yes, relatively stable, but we are still dealing with that crisis of confidence in the crypto industry as a whole. Binance being pushed to prove it has reserves to back customer assets one for one. Its auditing firm now no longer working with crypto clients, so that throws a little bit of a wrench in that plan. And as a result, you do have crypto-related stocks down in pre-market trading, even though Binance, of course, not a publicly listed U.S. company, so we can't track Binance. But Coinbase, Marathon Digital, they're both lower. And really broadly, Anna, you have technology stocks underperforming today. The mega caps like Microsoft, Alphabet, which of course is the parent company of Google, Apple, all of them are lower in today's session to the tune of about 1.25%, Anna.
Yeah, so that's the pressure that we're seeing on some of those big tech names coming through on the US session. Let's move on and show you what's happening here in Europe then. We've got Stocks Europe 600 down by 1.2% this morning. It is only the banking sector still that is in positive territory as markets increasingly focus on a higher rate environment or continue to focus on that higher rate environment, certainly here in Europe and specifically actually away from London in the Eurozone where we're seeing rising yields. That seems to be something that is pushing the banking sector higher. But elsewhere we see stocks under pressure and as you can see, down by 1.2%. The pound at 121.57. We actually have seen quite a recovery in the pound, of course, from those lows around 103, something which bodes very nicely on a personal level for me as I'm planning to come to New York next week, Kaylee, as you know. But we've got the pound at 121.59 then. Mixed data, really, in terms of the services sector, which actually showed some strength this morning on that PMI data, but also on manufacturing, which was a whole lot weaker. Maybe that creates a bit of a headache for the Bank of England, the strength in the services side. And the euro 106.22 is where we trade. A lot of focus on that yesterday with that hawkishness from the ECB. We saw a spike up and then a subsequent retreat in the euro as a result of that. The Italian 10-year yield is really interesting because we see those yields going higher, ongoing focus on what's happening with interest rates from the ECB. And that is something that the market continues to think about this morning, Kaylee. It's not just been a story of yesterday. Today we see French yields, German yields, UK yields, and Italian yields all going higher.
Yeah, and of course, Anna, it's been a massive week for central banks, and we have another central bank decision that just crossed the wire. The Russian central bank leaving its key rate, as expected, at 7.5%. And the Bank of Russia saying inflation as of December 12th is at 12.7%. They say labor shortages are increasing in many industries and that the global environment constrains economic activity. Of course, there are some idiosyncratic factors here for Russia when it comes to sanctions and being cut off from the broader global financial system. But right now, the ruble is holding losses versus the US dollar after that rate decision. But as I alluded to, this rate decision, just one of many, I think almost a dozen central bank rate decisions we've had this week. It has been a long one for sure. So joining us now to discuss is Des Lawrence, State Street Global Advisors Senior Investment Strategist. Des, has your thinking on the trajectory of central bank policy in 2023 changed at all over the course of this week?
Well, look, I think the data corroborates our thinking already. So it's not going to be a straight journey. We're going to see some bumps along the way. We've held the view that there's a disinflationary impulse coming through down the line, and we'll see that more clearly as we go through next year. So I think, interestingly, what central banks have said, in a way, tells us we've got a bit further to go, but it also confirms there's a lot of uncertainty there. So to take a simple example, if you look at the Fed's range of its own projections for the Fed funds rate in 2024, there's a 250 basis point range, span across that range, which tells us there's a lot of uncertainty, even amongst Fed members. So, excuse me, we feel that as we move through next year, that uncertainty will weigh more the softness in the economy, and that the interest rate hiking cycle will come to a halt, and we'll start to move into cuts later next year. It will take a while to get there, and we can see that happening across other economies, other blocks, probably a little bit later as we go through the first half of next year. But certainly something that's coming, and I think in the meantime, we just got to brace ourselves for a lot of choppiness.
So, Des, is essentially what you're saying when Chairman Powell stands at the podium preaching higher for longer, when Christine Lagarde at the podium yesterday said very clearly in very decisive language the ECB is not pivoting, that is not credible?
I think what they mean, to be fair, is it's subject to data. And that data, in our view, you've seen it in the UK data this morning, you've seen it in Euroblock data. Those PMIs are softening, the retail numbers are softening, a lot of stress at the consumer level. And central banks will acknowledge that. But what they do need is they just need to see more corroborating evidence that inflation is under control. So to be fair to the Fed, they've seen two nice prints in November and December. They probably want to see a continuation of that, and they want to see it corroborated in other data. And as we see that, we think that's when their storyline will change. So to be fair, they don't have full visibility. So clearly today they're in the camp of, let's get the inflation job done. Better to do or to warn of a little bit more initially than to have to do a lot more later. And I think, in fairness, that's the spot they're in, and it's that dilemma. But the data will help them to change direction as we go through next year, when this current wave of softness potentially amplifies at consumer level.
Okay. So, Des, at the here and now, we're seeing a spike in European yields. But given what you've said there, does that mean you're not concerned about that being a threat to the equities argument, because you think that the central banks are going to pivot? So those yields, that yield spike we're seeing today will unwind?
Yeah, no, that's a good point, Anna. I think, but it'll take a little bit of time. So that's back to my point, and you made it earlier this morning. The same point. We haven't seen perfect unanimity or cohesion of thoughts across the Bank of England, the ECB, and look at the Fed range for 2024. As I said, a really wide span there. So there's a lot of uncertainty as regards how the policy transmission is working. 425 basis points in the US, 250 in the Euro bloc. That's going to feed through, and different members will have different views about when that bites. So I think when we look at fixed income, we can see that we're getting closer to good value, fair value in the US, but in the Euro bloc, we're probably a little bit away from that yet, but we're getting in that direction. And that's to your point earlier, that bank stocks doing nicely this morning, so there is some reprieve coming on the way, but we're not quite there yet in terms of the big picture. So I think as we move through next year, yeah, that will come about, that we'll see some kind of ceiling on rates.
Back to the US stocks theme, Des, and we heard from Bridgewater earlier on saying that one of the big game changers of late is that, here we are going into next year and the Fed is not going to have your back. That was the words of one Bridgewater voice that we heard from earlier on. So I suppose the point they're making there is even if we see a slowing of the hiking cycle as we're witnessing, even a stopping of the hiking cycle maybe sometime next year, that's not the same as the very supportive low rates environment that we've seen. How much of that is that a threat to your slightly more positive view for stocks?
I think it's always in the mix. One of the things we've been looking at to try and read through that is the earnings cycle. And if you look at upgrades versus downgrades, they're still holding steady. So when we look out through next year, we're reasonably constructive. We think investors should play it wisely, though, and have some exposure to factors like quality and value. Value, to your point on banks, quality, simply less leveraged companies, good quality earnings can give you a bit of protection as we get choppy. So we will see more volatility in the coming quarters for sure. But overall, the market is starting to come back to levels where it's kind of closer to fair value. Now, for context, we've had a big run up since the end of September, and it's not unusual that we get that kind of a run up. So we've stretched a little bit beyond, so we're taking a bit of profit back. I think, to be fair, to go back to the point you made, the Fed has got to try and tighten financial conditions, and as it talks a reasonable game, the stock market runs ahead, which means it loosens financial conditions. So it's trying to navigate that thing. It's got its own feedback loop going on here with the markets, and those markets are loosening up policy a little bit. But now in the last 2 days, we've gone back in a direction that Powell and others would probably like.
Okay, thanks so much, Des. Really good to speak to you this Friday. Des Lawrence of State Street Global Advisors. Coming up on the program, Goldman Sachs sees commodities soaring in 2023. More from our interview with Goldman's Jeff Curry, a really important contribution to where inflation goes more broadly as well. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Anna Edwards in London. Matt Miller is off today. While Goldman Sachs, Anna, says commodities will be the best performing asset class once again in 2023, handing investors returns of more than 40%. Bloomberg spoke with Jeff Curry, the global head of commodities research at Goldman, about that call. Take a listen.
Go back to our call for a super cycle back in October 2020. You had 42% returns in 2021. You know, so far we're headed towards somewhere around 23, 24% returns in 2022. So this is a continuation of the strong returns that we've been seeing over the last several years. I think bottom line, when we think about what a super cycle really is, it's not this big upward trend in prices that we have envisioned in our heads. It's a sequence of spikes. And because commodity prices perform an economic function, they have to rebalance supply and demand, bring them back in line when they get out of line, like they did at the end of 2021 and the early part of this year. Well, markets are rebalanced right now today. Why? Because China is being locked down. So demand came back down on top of supply, prices collapsed back down. But we have not been investing in supply. Supply is stagnant. So I have to just simply ask, what happens when China, the largest commodity consumer in the world, the largest oil importer in the world, begins to rebound significantly in the first part of next year? It's going to tighten all of these markets tremendously and put a lot of upward pressure on prices. And I think the key point is, you know, you basically have the largest, you know, commodity consumer in the world essentially hibernating over the course of the last year. And that's been hiding a lot of this underinvestment. So really the core point here, underinvestment, weak demand today, but we see sequential growth in 2023. It begins to tighten these markets. One last point, inventories have been exhausted.
Jeff, let's talk about that China narrative. We are seeing a huge 180. There is a huge U-turn by China. They are reopening. But what comes with that is likely to be a huge pickup in cases. We're starting to see data being crunched on that, and the numbers look pretty bad. How should we be thinking about the China reopening, therefore? Is it going to be similar to the one that we experienced, i.e. stop, start, stop, start? And kind of how does that work? How does that impact the commodity price?
I think oil is a testament to it. It's going to be a really rough, bumpy start at the very beginning. But so oil is doing like this, you know, each week, big violent moves, because you know, you're going to have your fits and starts and stops. But when you take markets like oil equities or copper, they're more forward looking. They're looking into March, April of next year. As a result, they don't have that same kind of noise.
Joining us now for more on Goldman's commodities call is Paul Wallace, Bloomberg Energy and Commodities editor. This has been an important story, I think, this week, Paul, because when we got the first initial lines about China taking a different stance and reopening, and it looked clear that COVID-0 was behind us, we didn't see necessarily such a huge embrace of that narrative by commodities markets. Certainly a lot of people were asking initially, why has oil not jumped on this? And it seems that Jeff Curry asking a similar question, you know, why have we are going to see, in his view at least, higher demand story coming through at the beginning of next year?
Hi, Anna. Yes, I think Goldman and quite a few other people, analysts and traders in the commodity market, see the same thing. They see a big jump in commodity prices next year as China reopens. I think in terms of the here and now, commodity investors essentially they have this attitude of seeing is believing. Yes, They know China is reopening and in many ways has already abandoned COVID zero, but they're not yet seeing that translate into higher consumption of gas and oil and metals. And I think a lot of them expect at least the first quarter of next year to be very bumpy because, as you and Guy Johnson alluded to, it's pretty messy in China right now. Cases are spiking. So at least in the short term, I think people are taking a wait and see attitude. But at some stage, toward the end of the first quarter or sometime in the second quarter, I think most commodity analysts see a big pickup in commodities demand in China.
So, Paul, if we're talking about demand picking up at some point next year when supply is still constrained, it strikes me that the closer or the longer we are into next year, the closer we are getting to the 2024 election in the United States, in which we potentially could have President Biden running for a second term. We know that oil prices have dogged him for some time. Is there realistically going to be moves that he can take similar to what he has already undertaken over the course of the last year, tapping the SPR reserve, et cetera?
Well, I tell you what, Goldman is predicting a 43% rise in commodities next year. I'm not sure there's anyone in the White House that hopes that will come true because if Goldman is correct, that means at least some more pain for America and, frankly, the rest of the world in terms of higher inflation. I mean, if you look at commodities year to date for 2022, they're up about 7%. They were up much higher around June since when they've slumped. So, yeah, I'm sure the Biden administration hopes Goldman turns out to be wrong. If it isn't and commodities do surge around the middle of next year, it'll be interesting to see what the Biden administration does. In terms of oil, I think there's not much more it can do with SPR releases. It's already released a huge amount, and it's obviously a finite resource.
Thank you very much. Bloomberg's Bob Wallace joining us there on the commodities beat. Coming up, the countdown to the World Cup final is on with just 2 days before the showdown between Argentina and France. We're live in Doha. This is Bloomberg.
This is my
stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kaylee Lines in New York. Now, we are just 2 days away. I know Kaylee's extremely excited from the World Cup final in Qatar, where Argentina and France will face off for football's absolutely ultimate prize. Joining us now is Manus Cranny. He's at the Lusail Stadium in Doha, one of the many stadia that were built for this tournament. And Manus, I mean, what is the atmosphere like on the ground then, as we all get ready to watch the final, or to try and ignore the final if we don't like football?
I think it depends on where you are. I mean, I'm not staying at the Four Seasons this time, Anna, so I'm not exactly in the rub and the hub. But I am out and about last night, and there is a palpable sense of excitement. It depends whether it's the kids from various countries, from the Nordics to Latin America. I mean, there is a real sort of sense of excitement. People are drifting in here now, even though we're a couple of days ahead of the final of France and Argentina. There's 2 new planes, 2 new flights coming from Argentina. They're going to charge 2 million. They're going to charge quite a lot of money to get on that plane. So there's a monster amount of Argentinians about to arrive in this city, and I think that's going to change the atmosphere. So there's a great mix and there's a great rub depending on the hotel you're in.
Yeah, I would imagine that there's going to be a lot of money spent over the course of this weekend, and I'm sure there's been a lot of money spent over the course of the World Cup in Qatar. Manus, would it be considered a success? Did this meet the expectation?
It depends, and I said this sort of through the morning with Anna a little bit earlier on. How do we define success? For FIFA, it has been a monster success. Looks like $7.4 billion, $7.5 billion will have been spent through the process of this World Cup. But Qatar spent $300 billion on this trade. $45 billion of it went on this whole area and this stadium, Lusail. The whole area is going to be a city afterwards in terms of viewership, through the roof. USA-England, the single biggest watched match ever in the history of soccer, not football, in the United States of America. So those numbers are gargantuan. In terms of the actual flow of numbers of people in here, they hubbed out of Dubai, and they haven't hit the numbers. 765 million. We're looking for about 1.1 million at the halfway mark. So how do you define success? And then there's the geopolitical and social issues, which have been very, very pertinent in this World Cup.
Yes, I can't believe that was the most watched game. I have to say that was one of the most boring games that I watched, the England-US game. I'm sure it set back the cause of soccer in the United States by some decades. Anyway, you were just hinting towards it there, Manus. Of course, defining success at this tournament, yes, you can look at the amount of money spent and whether it's met the goals of those who wanted to host it. But you can also look at brand Qatar and how that has performed on the world stage.
Look, brand Qatar in of itself, Anna, and Kaylee's in New York, you know, suddenly this island nation is on the world map. Spectacular stadiums, but also there are the social issues which have risen and we must continue to talk about these, not just in Qatar. LGBT rights, human rights, labor rights, and indeed there's an upcoming, there's an upcoming court case in the United States of America which will refer to an indictment leveled in 2020, accusations of payments to win this tournament. There are many facets that you can be negative about. However, I'd almost see you and raise you and say, what you don't see at home in London and in the United States is a galvanizing of the Arab world. Mohammed bin Salman from Saudi Arabia coming here, sitting with the Al Thanis. These are many of the facets, but we should not continue to talk about some of those issues that have been raised. Ladies.
Yeah, absolutely. Manus, thank you very much. Manus Crowley on the ground, reporting there from Doha, talking about the controversy around the World Cup, but also the coming together of various Arab nations. Interesting phenomenon. And, of course, we wish good luck to, I don't know, Argentina and to France at the weekend. That is it for early edition. You are? Okay, allez les bleus. I'll go with the French then. That's a European thing. Right, that is it for early edition. Surveillance, more of that ahead. They'll be hearing from the New York Fed President, John Williams. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Inflation has turned, but there is evidence that it is sticky.
We're now transitioning to this environment where central banks are divided over how do you wrestle with inflation rates.
For the ECB, for the Fed, it's all about real rates.
Central banks have kept interest rates too low for too long.
In some respects, I think the Fed's been dealt a better hand than the ECB.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Do you remember that softer CPI print?
No,
like 10 years ago.
Exactly, maybe, but it doesn't seem to be playing out right now.
Live from New York City this morning. Good morning, good morning. That feels like a lifetime ago. Equity futures right now down 1.3% on the S&P, adding to the losses of yesterday. What did President Lagarde say that had an effect on this market that Chairman Powell didn't say and couldn't shape this market?
We're not going to pivot again. How many times do I have to say this? What language do I have to speak? We're going to go, and we're going to go hard. Also, the projections changed. They upgraded their forecast for inflation, and they had a uniformly hawkish expectation for what they're going to do.
And rates are moving big time. In Germany, in Italy the last couple of days. So Thursday, up 30 basis points. This morning, up another 21. How quickly does this start to become a problem for this ECB?
I am going to wonder what's going to happen with that. At the same time, you had better than expected PMI data that came out of Europe over the past 24 hours. So they're kind of leaning on a bit of strength and a bit of a reprieve from the natural gas prices that they have. To your point, this is the reason why people don't believe some of the hawkish speak in the U.S. At what point will they start pushing back with that lack of credibility in the Eurozone?
Fed speaks back today. You excited? Coming up a little bit later this morning.
We've got a host of Fed Speak. I am wondering if they push back against the market a little bit more. If they say what Bill Dudley said, which is the more that the market doesn't believe us, the harder we have to go, the more we have to punish you, which is essentially what some of the rhetoric had been earlier in the year.
The former Fed officials are super hawkish. Super hawkish. They sound more like President Lagarde than the current Fed officials. Looking forward to catching up with Mr. Williams a little bit later. Brammo will give you the time of that in just a moment. I want to go through the price action for you. On the S&P, we are lower by 1.4%. I've talked a lot about the bond market in Europe. We'll continue to do so. But on a 10-year in America, up another 4 or 5 basis points. On the 10-year, 349.32. Euro dollar just seems to be stuck between a rock and a hard place. Is this positive, the currency, or is it negative for the currency that this ECB is determined to hike interest rates, Brammo, into a recession, 106.21?
This has been the dilemma all year. Traditionally, the more hawkish a central bank has been, the more you start to see strength in that currency. And this year's turned it on its head because weakness has meant a weaker currency, and people are trying to struggle with that. And you're seeing that with a lack of direction, really, in the euro-dollar cross. Right now, what I'm looking at is Fed Speak. We do get a host of it. I know you're incredibly excited. New York Fed President John Williams joining at 8:30 a.m. alongside Bloomberg's Kathleen Hayes. Later in the day, we get San Francisco Fed President Mary Daly. That's at noon. And then with our own Michael McKee, Cleveland Fed President Loretta Mester at 3:30 p.m. How much do they push back against some of the optimism, the hopium, as some people would say, in equity markets? At 9:45 a.m., we get the S&P Global U.S. Manufacturing and Services PMI for the month of December. Do we get a 6th consecutive withdrawal or downturn in some of the basic manufacturing and services sectors in the U.S.? Does that give you a sense, perhaps, of that soft landing? How do people interpret it? Do people even care at this point? Have people just left for the holidays?
Data's been really mixed. I've got to say, if you look at the data that came out yesterday, retail sales was at the worst in 11 months, dropped the most in 11 months. You looked at industrial production, factory production declined for the first time since June, and then jobless claims just kind of ripped up the script. 211. Close to 200,000. I think that's really confusing for a lot of people.
Which is the reason why a lot of people aren't going to look at any of it and just watch the World Cup on Sunday at 10 a.m. Where Argentina and France face off, and they're going to basically cash it in for the year.
And for TK as well. He's away today. He's going to come back on Monday. He's got France as his winning team, and his bracket is absolutely dominating.
How do you feel about that?
I think he's placed 30 in the whole of Bloomberg in the firm out of thousands.
How
do I feel about that?
You gave him, I think, 20 seconds to talk about that yesterday. You were like, all right, here's your victory lap. Go.
I said,
okay,
congratulations. I mean, the issue is, and I'm terrible at this, and I said this ahead of time, he chose his teams based on the colours of their jerseys. And he likes blue, so he went France-Argentina, but he likes France blue that little bit more, and he's going with France. That was the logic that went into this.
Which really bothers you because you gave a lot of thought to it and got it wrong.
As a tiebreaker, just so everyone
really
understands, as a tiebreaker in the World Cup bracket here at Bloomberg on the terminal, you have to choose how many goals are scored in the tournament. Okay, so I went with about 160. Do you know what Tom went with? 4. That's how much Tom knows about football. Okay, that's his tiebreaker.
No one thinks that he's coming from a complete place of knowledge. I do think it's going to be interesting, though, to see Mbappe versus Messi. And I will say that the one thing that's been the takeaway is Messi has won out over Ronaldo in terms of
big time,
the best player and the one who's going to be most respected going down.
Big time. Let's see how things take shape on Sunday. This is how things have taken shape this week. President Lagarde with maybe her most hawkish address I've ever seen.
Anybody who thinks that this is a pivot for the ECB is wrong. We're not pivoting. We're not wavering. We have more ground to cover. We have longer to go. This is not a pivot. We're not slowing down. We're in for the long game.
Let's go through that language. We're not pivoting. We're not wavering. We have more ground to cover. We have longer to go. Lisa, we're in it for the long game. It was pretty blunt yesterday, wasn't it?
And then Bloomberg came out with a story saying that a couple members wanted a 75 basis point rate hike and that was a serious contention. So sort of adding to this feeling, there still is a lot of feeling that they need to curtail this inflation.
Let's get to Steve Chiavaroni, joins us now, the head of multi-asset solutions at Federated Hermes. Steve, I'd love your view on what we've heard from the Federal Reserve, the Bank of England, the ECB this week.
Well, I mean, it was refreshing to hear a very clear, concise view from President Lagarde. I think sometimes in the U.S. we start off there and we go a sentence too long and we provide some confusing, wavering advice. But look, I mean, regardless of the Fed speak or sometimes the communication mishaps, the story of 2022 has been one of a Fed that has consistently moved in a hawkish direction and continues to do so. And I think if you look at what's going on in the labor market, you can really understand why. And so I think, look, we've got 75 basis points worth of hikes left in the dot plots. I think you're likely going to see that. And I think you fight the Fed on this at your peril.
Which is the reason why a lot of people are wondering why so many people are fighting the Fed. In fact, the consensus is fighting the Fed. I'm looking right now at the terminal rate that people are looking at for the end of next year. It's 4.4%. The Fed is saying it will be 5.1%. How does that really squeeze out risk appetite? What has to give in markets as people get back to either the Fed's point of view or, as the Fed drops it, to the market's view?
Yeah, look, I think the market has misinterpreted a couple of things. We have seen a drop in the CPI data over the course of the last couple of months. That's encouraging. But if you look at where it's come from, it's primarily come from goods. It's primarily come from flexible priced items, which you're not seeing at this point. And the Fed, I think, is starting to call this out more acutely. What you're not seeing it occur in is the service prices, and in particular, sticky price goods and wage inflation. You are simply not going to get to a consistent 2% inflation rate if you're running wage growth between 5 and 6%. And the only way to fix that is to get the labor market back into equilibrium. I think the reason that the Fed hasn't been as clear as maybe some of the market would like is because that's very delicate politically to say, look, we need the unemployment rate to go above 6%. But ultimately, I think that's where it needs to go, and I think that's where they're pushing. So you can see good prices fall. That's not going to dissuade the Fed. What they said very clear this week was they need to get the labor market back to equilibrium, and they're simply not there yet. Otherwise, they risk a re-accelerating inflation a la the 70s.
Well, Steve, this speaks to something
that yet.
We heard from Michael Harlow at Bank of America this morning. It's okay, I just wanted to share this quote with you. Central banks tightening into a mid-23 hard landing. That's what he's talking about. And echoing what you just said, we've had 400 basis points of Fed tightening in 9 months. We're going to get another 75 potentially in the next 5 to 6 months. Throws in the ECB, 250 basis points in 6 months, likely to get 125 more expected over the next 9 months. And he said this, and Steve, I wonder if you share this view. Quicker labour markets break, the quicker the end to the bear market. Steve, do you share that last line? Do you share that view?
I do. I just don't know if it's going to play out that way. The recession here is the bull case. If you get a recession, if it has some depth, if you wring out inflation, then I think you're on the other side of it. You can get back to some monetary stimulus, and you're right back where you were pre-pandemic. I think what's emerging, though, and the thing that has us concerned is 2023 could end up being a kind of widowmaker in terms of a market, where you've got two consensus views out there, John. One is the soft landing crowd. The other one is a kind of early, shallow recession. You see a lot of this in the strategist community, kind of a first quarter recession. You're well on your way to recovery by the back half. We're starting to think that, the trade that causes the most pain to the most people, and therefore might be most likely, is a later recession that happens to be deeper, that it takes longer for those labor markets to break, that the Fed has to go further to wring out the inflation. And so you could have a scenario where the soft landing folks are breaking their arms, patting themselves on the back, and the early recession folks are capitulating, right as you get a second half kind of meaningful slowdown. That's going to be a very difficult environment to navigate, because it means you could have a first half rally. So we just think that the word of the day for next year is humility. If you've been wrong on inflation for 2 years and wrong on rates for a year, don't think that you're going to be able to call the path next year with certainty. Yes, it's going to slow, but who knows when? And I think it could be later than people think.
Just quickly then, Steve, as you basically pack up your bags and get ready to check out for the rest of the year, what are your final sort of portfolio arrangements that you're doing to prepare for that turmoil, that humility?
Yeah. Well, it's a closer to neutral portfolio. We're just very slightly underweight equities, but we are underweight. We have a preference for dividend paying defensive stocks, which I think do well in a market that slows. We're in cash. We want a lengthened duration. Everyone wants a lengthened duration, but it's not as compelling at 3.4% as it would be at 4%. So, we're going to be patient in lengthening that duration. We're underweight credit. we're probably not as underweight cyclical stocks as we would like to be heading into a recession, just so that if we have a kind of first half rally, we have some ability to participate. That's how we're positioned, and we'll see how things break.
Hey, Steve, looking forward to catching up with you through the new year. Thank you for everything you've done for us this year. We appreciate it, Steve. It's good to catch up, buddy, as always. Steve Chevron there of Federated Hermes. Do you know what I'm really confused by in central bank news conferences at the moment? On the one hand, they say no forward guidance, and on the other, they offer you forward guidance. President Lagarde yesterday, meeting by meeting, but ultimately indicating that we're going to go 50 for the next couple of meetings. What is that about?
Okay, basically, they're not going to tell you what they're going to do, but they're going to tell you
what they're going to do.
What they're going to do. They can't. The problem is that when you have markets that are forward discounting mechanisms, how do you not provide forward guidance if you want to use financial conditions as your tool to affect monetary policy? I mean, it makes your head spin.
Hey, there's no forward guidance, but there's no cuts next year, okay?
I'm just very humble.
Just make sure you price that in.
Very humble.
Emily Rowland of John Hancock Investment Management in the next hour. And that softer CPI print, I tell you, it feels like a lifetime ago. This equity market is lower again this morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Russia has launched another large-scale missile attack on Ukraine. Several cities have been hit, including the capital, Kyiv. Widespread power outages have been reported. The attack comes a day after a top Ukrainian army commander warned there's no doubt Russian forces will try to seize Kyiv as soon as next month. A Russian assault in the spring failed. In Beijing, a rapidly spreading COVID outbreak has turned the Chinese capital into a virtual ghost town. That underscores the cost of President Xi Jinping's sudden pivot away from COVID zero. Anecdotal evidence suggests entire families and offices in Beijing have become infected in the span of just days. That could be the preview of what the rest of China faces. The Senate has averted a possible shutdown of the U.S. government. Thursday night, it passed a one-week funding bill needed to keep the government in business past Saturday. That gives negotiators more time to hash out agreements on funding levels for federal agencies for the current fiscal year. Twitter has suspended the accounts of several prominent journalists covering the company's billionaire owner, Elon Musk. Musk says they were endangering his family by posting his real-time location. The journalists deny that. Those suspended include reporters from the Washington Post, New York Times, and CNN. And Boeing is closing in on an order for as many as 200 of its own 737 MAX jets from Air India's new owner, Tata Group. Bloomberg's learned the two sides are trying to wrap up talks before the holidays. Tata is working on rebuilding the formerly state-run airline. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The secret success of any company is to grow. And I think that we, WPP, and our industry more broadly, can be really at the heart of a client's growth. You know, how do they succeed with consumers? How do they reach them in new areas? How do they innovate? How do they create new brands?
we need to be prudent in terms of costs, entering into 2023 in particular, even postponing to just wait and see how the environment is turning. But I think we need to also carry on investing.
That was SocGen CEO as Europe faces tougher times. Mike Mayo coming out yesterday of Wells Fargo. This is what he had to say about the financials in the United States. Banks should perform better in an upcoming recession than for any other in modern history. Lisa, he went on to say banks have prepared for this moment for over a decade. Now, are we talking about relative terms or absolute terms?
Absolute terms, just the amount of cash that they have on their balance sheets. The fact that you have really highly capitalized banks that have been arguing that they are too safe and that they have not been able to invest in risk, and suddenly risk is toxic again, and now they have the ability to keep lending and to survive. And so this is why he sees them rising 50%.
Well, that's my point. If someone said that, typically I'd be thinking, okay, so you're looking for relative outperformance to the index or to another sector, but you're looking for absolute returns, 50% of that group next year going into a recession in America.
The idea here is that they've been so beaten up for so long, and they've been so undervalued, and that suddenly people will view them as more of a play on a new cycle. Again, you can argue, Mike Mayo always has fabulously controversial calls.
And props.
And what?
And props.
Yeah, what prop would it be for this?
I've got no idea.
A toaster?
Unicorn.
That you can get? Next time you sign up
50% move. If we get a 50% move, fair play to him. He knows more about banks than I do.
There's your prop.
He's saying it's showtime. Showtime for the financials. We'll pick up on that a little bit later on the equity side of things. Let's head over to Europe with Maria Tadeo in Brussels and head down to DC with AMH. Maria, can you help us all understand where the Europeans are on this energy effort when it comes to capping prices?
Well, you are confused. I've been confused. Our viewers probably have been confused because this is a conversation that's been going on for months now. But just to reset and take everyone back, for weeks, the Europeans have said the TTF, remember that is the main benchmark for gas prices, no longer reflects the nature of the European energy market, which has moved away from Russian gas. So they want to put a cap on the maximum price that you can pay on that. The initial proposal by the European Commission was to cap it at 270 euros megawatt hour. That was not agreed, and yesterday night, European leaders, the vast majority of them, agreed that there should be a cap but change the price range. The range is now between 160 euros to 220 euros megawatt hour. What's changed here is that there is now a majority to get this price cap going. In fact, they have a deadline. They told European ministers, come Monday, you need to get this deal done. It cannot drag into 2023. The question is, how do you settle? What's the price point? And at this point, we don't know.
And Maria, probably the reason why people are struggling with this is because suddenly you're making this a closed market. It's not a market at all. And Maria Tadeo, I am wondering from your perspective whether the disagreement comes from who profits from the supply-demand dynamics that underpin normal economics. Do you have to finance the energy companies, the natural gas producers, or do you basically tell them this is going to be on you, keep producing, but we're not going to pay you?
The fundamental disagreement, and maybe I'm guilty of this too, is that when we talk about the European energy market, the reality is there isn't one. You have 27 countries that have different systems, that have a completely different energy mix. Some that worry about supply, others that worry more about price, some that have the fiscal capacity, others that do not have the fiscal capacity. By the way, the Italians are fuming after that decision yesterday from the European Central Bank, and the message from the Italian Prime Minister yesterday is that there needs to be a European solution that brings down energy prices, so you can see the tension building. But the fundamental issue is that we talk about a very complex global market, but at the same time, there isn't a unified European energy market. This needs to bring in 27 different countries that do not share the same vision, and that is fundamentally always a reason why conversations like this drag on for weeks, months, but ultimately, usually end with a deal.
Anne-Marie, is anyone talking in Washington, D.C. Ongoing about possibly curtailing exports to Europe of natural gas? There was some discussion about that when prices were surging here in the U.S. Then they fell off. Now they're rising again in the face of colder weather. What's the talk in D.C.?
Well, there's always this potential that the U.S. could do that, right, to make sure that they're shoring up their own supplies for U.S. consumers. But the issue is that when you look at the market dynamics, what that would do is just increase the prices overall in the global market, and that's where everything is traded, so it could potentially backfire. And I think at the moment what you have is that potentially this is something that people do bring up, but it would really be a huge move, and the United States is just nowhere near that yet. It also would not look great for the administration that's really trying to make sure that they are holding this alliance firm, especially as we go into the winter months. And what you see Vladimir Putin doing, what you see him doing today, is another day of barrage of missiles, and this is on key Ukrainian infrastructure. So really trying to starve the Ukrainian people of power, of water, electricity, gas, so they can heat their homes. So at the moment, I just don't think there's an appetite for that.
MH, on that war, a few days ago, we were waiting to see if we get a decision on new defense sent to the Ukrainians from the United States. Where are we on that decision?
Well, we do have huge bipartisan support with the passing of the defense spending bill last night in the Senate, and that will send money not just to Ukraine, but also Taiwan. I mean, $858 billion. And then, of course, the next week is going to be all about the stopgap funding so the government can continue operating and they avoid a shutdown. When it comes to the Patriot missiles, we are still waiting on an announcement from the U.S. government. And reporting has been that President Biden has yet to sign off on this, but that they are moving to send those Patriot missiles to Ukraine. But we went through this. There's a lot of questions about that. Will they be the newest grade, or will they be a little bit of the older versions? Where will individuals get trained on them? But this is something that President Zelensky has really been pushing for, especially now when yesterday you had top Ukrainian official talking about the fact that they think Putin can make a play for Kiev in January and potentially do that via Belarus. He's moved thousands of troops into Belarus. And on Monday, Putin will be visiting Lukashenko in Minsk.
Anne-Marie, just quickly, we know why the Ukrainians want that missile defense system. Can you tell us why the US is reluctant to provide it, why they're hesitant about doing so?
Well, there's been a lot of hesitation with some weaponry going over to Ukraine because already even the talk of Patriot missiles, what you heard from the Russian foreign ministry is that they view this as an escalation of the war, and they view this as the United States basically joining. What the U.S. has always wanted to do was contain this and didn't want to escalate it further.
MH, Maria, to the two of you. Maria, don't worry. We'll get your thoughts on a World Cup in about 60 minutes from now on TV and radio. She's done. Is that it? Is that the decision? Is that who you're going for?
It is from me.
Everything will be revealed. No. Everything will be revealed in due course. We don't do it like this in surveillance. Everything will be revealed with good arguments.
That's the tease.
But she's speaking in French.
I thought she'd given it away.
Yeah, exactly. You're going to speak in French, but it's not clear who she's going to
On surveillance, there must be good arguments, but then didn't provide anyway. MH, Maria, coming up in 60 minutes again. I want to draw your attention to this story. And forgive me if I'm pronouncing the name of this firm wrong, but French auditing firm, Mazars Group, has paused work for all crypto clients globally, according to crypto exchange Binance, which was a customer of said auditing firm. That firm, quote, has indicated that they will temporarily pause their work with all of their crypto clients globally, which include Crypto.com, KuCoin, and Binance. Lisa goes on to say, unfortunately, this means that we will not be able to work with Mazars for the moment. That's according to a spokesperson for Binance in an emailed statement to Bloomberg News a little bit earlier today.
I don't want to extrapolate and however, there is a sense of concern that's growing of how do some of the big crypto clients, how do they really deal with a lack of clarity around things like proof of reserves, around things like their streams of finance, some of the things that really hit FTX hard. And those that did have auditing firms could rely on their credibility. If you have one of those major finance firms, auditing firms, pull away, what does that do in terms of potential consequences going forward?
The Binance spokesperson went on to say, we embrace additional transparency and we are looking into how best to provide those details in the coming months. If we get additional detail, we'll share it with you. Coming up, Callum Pickering, the senior economist at Berenberg, on a massive week for central banks. 50 basis point hike from the Federal Reserve, 50 from the Bank of England, and 50 from the ECB. And an ECB that says we're going to do a whole lot more. Live from New York, this is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Closing out the week on a bit of a low on the S&P right now. We are lower by about 1% on the S&P 500. Futures negative on the Nasdaq by 0.7%, adding to the losses of the last couple of days, Wednesday, Thursday. In the bond market, 2s, 10s and 30s on treasuries shaping up as follows. Your 2-year actually hasn't done a whole lot over the last few days. It's still in and around 425 on a 2-year in America. On a 10-year, bleeding just a little bit higher by, let's call it 5 basis points to 349.50. If you want to see a move, look to Europe. Wow, wow, wow. Yesterday, we had a monster move in Italy by 30 basis points, and we're up another 20 on a 10-year to 437. Lisa, in Germany, the 10-year there, up 10 or 11 basis points to 219. And SocGen, saying there's more to come.
2-year yields in Germany were up more than 20 basis points just yesterday. That is the biggest one-day move going back to 2008, that according to Deutsche Bank's Jim Reed. How much further can they go before something breaks? You pointed this out, and I keep going back to that. We were talking about the impossibility of the central bank ever moving above zero. And here we are, going further and further, and nothing has broken, and people are thinking, well, maybe we can even have a soft landing. Is that possible?
I won't say things have broken, but are things breaking when you look at Italy? BTP's at 430, is that a problem? 450? Is it a problem at 550? When does that start to become a problem?
We will find out when it becomes a liquidity issue as well, because right now it hasn't necessarily become the same kind of liquidity issue, causing people to not be able to raise money because people don't have to yet.
And QT hasn't started yet either. That's going to start early next year. What did you make of what we heard on QT? On the rates thing, I think on rates, without a doubt, hawkish, pushing back against the terminal rate. If you were thinking that was the last 50 basis point high from this central bank, they're going to go again. They might go again. They might go again after that. On QT, was that QT light from this ECB going into next year?
Just going to say that. I mean, it's pretty minimal, the amount that they're rolling off every single month, number one. And number two, there still is that emergency purchasing program from the pandemic that will continue to make reinvestments through 2024, giving them a little more leeway, potentially, to offset some of the pressures that you're seeing in the periphery.
Yields in Germany and Italy absolutely flying. ECB President Christine Lagarde sending a warning to markets. It's time to adjust.
More needs to be done, and as a result, new market expectations will hopefully be embedded in future staff projections, which will indicate that we can reach the 2% inflation target timely.
More work needs to be done. Callum Pickering joining us now, the senior economist at Berenberg. Callum, have you ever seen President Lagarde as hawkish as she was yesterday?
No, that actually took us a little by surprise at just how hawkish she was, especially given the fact that we can see evidence that the Eurozone economy is in recession, that there's probably not a major demand-side element to this inflation. We don't see any weird stuff going on in wages, for instance, like we might in the US or the UK. The danger here is that central banks start to go a little bit too far. Monetary policy works with a lag. all the major central banks reacted too late to inflation. Now they may be repeating the opposite mistake as well, reacting too late to the signs of disinflation.
Callum, do you think that something could break given the pace of some of these recent moves?
I mean, it depends how you define break. In one respect, central banks want stuff to break because that's the thing that gives you the recession that brings out the inflation. We like to think that central banks can fine-tune, but they really can't. They're powerful institutions, but they're clumsy. A soft landing, in my view, is a recession that doesn't entail a major drop in GDP, such as, say, 4 or 5%, or a major rise in the unemployment rate. I think what we're going to get from the Eurozone economy and the UK, probably the US eventually as well, is 1 to 3 percentage point drops in GDP, depending on the economy, a bit of a rise in unemployment. But that's based on the fact that central banks don't go much further than they already have. But of course, if you keep going, you find tolerance levels for everything. Eventually, stuff starts to crack. You simply can't price loans once interest rates rise to a certain level.
Callum, I was surprised at some of the projections that we saw, not only from the ECB, but also the Federal Reserve, increasing their expectations for year-end inflation next year and in 2024. The ECB's expectation rising more than I had previously thought, and even more than what the Fed upgraded theirs to see. What are they seeing that's sticky if it's not wages, if it's not demand side, the way you're saying?
It could just be that we've had a structural break, and I think this is probably the reason, in the way that central banks view inflation. We've had for certainly 12 years after the financial crisis, but actually even in the early 2000s, central banks were thinking about this zero lower bound problem, where in a disinflationary environment, you get stuck at the zero lower bound and central banks struggle to stimulate. In that kind of world, you would be prone to react strongly to downside risks, especially if they're disinflationary, but just take your time in reacting to any upside inflation risks. Now we're in a world, and increasingly you hear economists discussing aging populations, deglobalization, the fact that fiscal policy is more activist again, is pushing inflation rates higher in the long run. In that kind of scenario, you say, well, we should overreact to signs of inflation, but then underreact to signs of disinflation. And so what we might be observing here is just that first shift that comes with that structural change in the inflation environment.
Callum, I want to talk about the threat of recession into next year. I think a lot of our audience have heard the same thing over the last 3 months or so, looking ahead to 2023. If we get a recession, don't worry about it. It will be short. It will be shallow. That's both on the depth and the duration. No big concern. We heard that again in the ECB statement yesterday, and I'll show you the line that reads as follows. According to the latest Eurosystem staff projections, a recession would be relatively short-lived and shallow. Callum, given their projections, given the pushback of this ECB president on terminal rates pricing, and given where this economy already is, how on earth can we keep sitting here and saying it's going to be short-lived?
First, I actually still think the ECB's projections are a bit too optimistic on the whole. I think the Fed's are too. The Bank of England starts to sound a bit realistic near term, but it's probably too pessimistic next year. The reason why you would, as your base case, assume that this is going to be a short-lived recession is simply because actually we're not ready for a recession across the Western world. We had 2 years of recovery from COVID, but during those 2 years, we barely got back to our pre-COVID levels of GDP. We didn't significantly over-leverage on the household or the corporate side. Banks' capital is still high. We don't have piles of excess capital investment or even excess inventory in major parts of the economy hanging around. We didn't have a big housing bubble where we built too much across Europe and the US. And so when you don't have those signs, typically the recession that comes due to an exogenous shock, and that's what we have a global energy supply shock, typically lasts as long as the shock lasts. And then once the shock fades, economies recover. That's very different from the other kind that I mentioned, the business cycle downturn, where you need to go through this cleansing phase. The problem here is if we tighten financial conditions too much into this exogenous shock, what we're doing is putting economies under additional pressure, and I think that's where the downside risk starts to come. My bet is that Bank of England probably gets another 25 basis points. That's it. Peak rate in the Eurozone's probably around 3.5%.